welcome everybody. Microphone working okay? Okay, so we have 10, really 9 items on our agenda. And due to scheduling conflicts. Oh, you got it. It's the new ones. All right, thank you. Due to scheduling conflicts, I'm going to make a motion that we take the agenda out of order. And I'll go through this, and then I'd like a second. So if you go to the second page and you look at item number 6, which is an update from Phoenix Advisors, we want to move that to item number 3. And then we want to take item number 5, which is to review the town's pension and OPEB funds for Mr. Brackfell, one of our favorite former Board of Finance members. For now. Good to see you back. And we'll want to move that to number 4, and then take item number, what's currently number 3, about the WPCA wastewater treatment plant, and move that to item number 5. And then everything else will remain the same, 7, 8, and 9. So can I have a second?
I'll second.
Second. No, 4 is going to become, well, which 4 do you mean? Regular for 4 becomes 6, yes. Currently number 4 will now be number 6. Thank you. Okay, so I have a second. All those, any other discussion? Okay, great. All those in favor? Opposed? It is unanimous. So we will begin tonight with Mr. Matt Spurndell from Phoenix Advisors. If you can come on up, and thank you for being here. So we will get an update from Phoenix Advisors on the fund balance percentage and debt level ratios for AAA communities as compared to the town of Fairfield. So we appreciate you being here. I mean, our AAA credit rating is very important, not only to this board, but to every board and to the town as a whole. And this is good timing to have you here with us tonight as we're walking into our budget. And, you know, we have a fund balance policy now that's part of our CAFR. And so we just want to review with you how we stand and any precautions that you might advise us about, and also just to get your, just clarify, you know, the positions of this Board of Finance and the town as we discuss, continued discussions on our fund balance and our debt level ratio. So I'll turn it over to you, and you do have a PowerPoint that was part of the handout.
I do. I think you should have it in front of you. Is this on? Do I have to hit a button? Hello? Okay. Yes, I prepared, and thank you for having me tonight. I'm happy to be here, of course. What we did was, as the municipal advisor for the town for quite some time, I was asked to come in and basically walk through some of the ratios and really the credit factors that come into play with respect to the town's overall credit, fund balance, debt, and some other items that are listed on this handout that I believe you should have. And if you all do, I'll just walk through and we could take a look at some things and stop for discussion at any point and ask any questions you might have. But basically what this is an analysis of the town of Fairfield relative to all the other AAA communities in the state of Connecticut, which you'll see there on the first page. If you flip over, it's the Moody's AAAs. So there's about, 15 or so other communities in there. And really what happens is when you go through the course of a rating call with any of the rating agencies, be it Moody's, S&P, or Fitch, oftentimes they look at not only your trends and those types of items, but also how you compare to other AAAs so that they can sort of fit you into the right category. And if there's any major concerns or outliers, it'll be pretty evident in some of these charts, which is why we put them together. So on that second page, we could start with the financial position. It's total fund balance, and I should note that this data is pulled from the Connecticut State Fiscal Indicators, which is put out by the OPM. The most recent release just came out last month. And I've also I've taken that data for the other communities and updated Fairfield's to the most recent audit and the official statement that we did in July, so that it's a little bit more up to date. But from one year to the next, these things won't change too much. So with that being said, total fund balance as a percentage of revenues is obviously a criteria that they look for. And you can see Fairfield's in yellow, all the other communities are in blue, and you can see where you fall on the spectrum there. Over 10%, I believe now it's something like 11.3-ish, so it's probably even a little bit higher than that. So you can see sort of where you fall, West Hartford being the lowest, New Canaan being the highest, right in there, in the middle, or in the mix there, in terms of your policy and those types of items. But one thing that I think is a little bit even more important than total is probably the unassigned general fund balance, which is on the next page. And you can see Fairfield right there, just about in the middle at the 10.3. Rating agencies look at total fund balance. They look at unassigned fund balance. They look at what they call available fund balance, was another metric, which is unassigned plus assigned. But I wanted to just show you this here, since it's something that I know this board has seen these charts in the past before, and some time ago, that yellow bar would have been quite a bit further to the left. So we're in very good shape with respect to the fund balance. You can see there. Stop me whenever you want to, or I could just keep going. Go ahead, Jim.
Mr. Walsh?
For our fund balance policy, we look at what the unassigned fund balance is as a percentage of total operating general fund expenditures. Do you have what the numbers are against expenditures as opposed to what it is against revenue?
I don't have those off the top of my head, but I know that with respect to what the rating agencies look at, either depending on the agency, some look at revenues, some look at versus expenditures. So, we tend to pick revenues for whatever reason. And I guess in a perfect world with a balanced budget, the numbers would be the same, which obviously is not the case, but plus or minus.
All right, because when the Fund Balance Committee was meeting about this, and we asked what number we should use, it said, we were told that most use it against expenditures. When most people say, what is your unassigned fund balance, or what is, commonly your fund balance,
Right.
it is generally what it is against expenditures, and that's why the committee chose to use that metric in the Fund Balance Committee.
It's absolutely a great metric to use. I think Moody's might use revenues. S&P uses expenditures.
Okay, so you don't know where we stand sitting here today against expenditures?
I don't have that number handy now.
All right, would you be able to get that to the committee?
I would absolutely
Thanks.
get that to you, sure.
And when you said previously that currently it's 11.3, that's because the revenues you're looking at are on audited financials. So they're
GAAP,
basically a year
yeah.
behind.
Well, we look at GAAP audited numbers
Okay.
because that's what the rating agencies use.
And what year were these GAAP audited
These would have
numbers
been
through?
for Fairfield, these would be 6/30/19, as far as that's what I used, yes.
Yes, Mr. Charlton?
Yeah.
So, and that's total revenues, not just tax revenues? So it would
Total
include
general fund revenues,
Total
yes.
general fund revenues?
Correct.
Thank you.
Yep.
Matt, in regards to have you looked at against expenditures?
I have not looked at this chart to expenditures, but I could do that, and I'd be more than happy to do that.
All right. Would you imagine that we'd be in the exact same areas?
I would say that you'd be very darn close, I would
Okay.
expect, yeah.
Okay. You think everybody would be in the same proximate ranges that they are?
I would think so, yes.
Okay.
Yeah. Okay.
Anyone else for now? Okay, turning it back.
Oh, thank you. So now stepping a little bit into debt, again, looking at the debt burden, which is your overall net debt to the equalized grand list, which is a metric that they obviously use. You can see there that where Fairfield lies around 120. That's including the bond issue from July and as well as the notes that are currently outstanding. So it's the most current number that we could have. So you can see, there's a few debt measures coming up to see how leveraged the community might be or it might not be. Important numbers as well as far as the overall rating. On the next page is overall net debt per capita. Just, obviously your overall net debt per person in the community, and you can see it's about $3,000. So again, similar location as far as the debt burden, roughly plus or minus. And keeping in mind that these are all AAAs, so we're really looking at, when we look at these types of charts, are there any outliers, or is there anything that really sticks out that might create a concern going forward? If you were, for instance, far left on these debt charts or even on the fund balance charts, those could potentially create concerns. So as long as we're sort of in the middle there, there's usually not going to be too much of a problem with the rating. Debt service to budget down below on the next page, that's something around 6.5% on the lower end of the AAA schedule, as you can see here. Okay. Okay.
Questions?
Just going back to the fund balance, I'm looking at West Hartford, which is on that left side you were talking
Right.
about. Kind of maybe it's an outlier. It does have a AAA rating. And West Hartford is the town that Fairfield is most frequently compared to in terms of having similar demographics, similar revenue, et cetera. Can you comment on that? Because their fund balance is it about 8%?
Right. It looks like it's about 8%. And I think it's important to note, too, that that you all as a board or other folks might see West Hartford as a comparable, which it clearly is, size-wise, some demographics and things like that. But I will say that when the rating agencies look at these numbers, in reality, they oftentimes, they have their checklist. They're looking to see where you fall versus the median for that AAA category. So although West Hartford might be a better comp from just a sort of a head-to-head kind of a situation, the analysts really will look at the entire mix of AAAs in Connecticut, but also nationwide. Now, that being said, West Hartford is on the lower end. I wouldn't call this quite an outlier, but in any of these metrics, there has to be a high and there has to be a low. They happen to be the low in this particular one. They recently did a bond issue. We don't work with West Hartford. We work with about 75 Connecticut municipalities, but not West Hartford. At any rate, in going through their reports that I recently reviewed from their issue in end of January, it does reference the fact that they have a fund balance that is on the lower end of the AAAs. It's a narrower fund balance position relative to the median, but that was about it. It didn't really give them any stern warnings that they're going to be downgraded anytime soon. It didn't mention they could have been put on negative watch or negative outlook, neither of which happened. So I think, in the overall context of a rating, we've only looked at a couple of the charts here, but I think you kind of know where this is going. As far as fund balance, finances, debt, economy, wealth, there's so many indicators that come into play that there could be a couple of those indicators that maybe are on the lower end, but then some of the other indicators pick that up and give the agency a lot of comfort that you're in the right category. So if I were West Hartford, I would look at this chart and say, well, I probably don't want to go too much lower than this, or that could now create a concern. There's some language in their report. It's nothing too concerning, but clearly that could be a cause for concern going forward if it were to continue to go down, which would be a result of operating deficits on a GAAP basis. So when you have an operating deficit on a GAAP basis because of use of fund balance, that also comes into play in the metrics and the analysis from the rating agencies, and it could be a potential negative ding. So I hope that answers your question. Thank you. Okay.
But Matt, let me ask you a question. You don't really want to be on that low end in case something happens, like a hurricane or something else like that. I mean, we're a coastal community, and we've gone through a hurricane. And being on the lower end of that, and then getting slammed like we did a number of years ago by a hurricane,
Right.
where we might have to dip into it,
Right.
our fund balance, could cause us to either be downgraded or to be put on a negative watch.
Anything is possible.
Yeah, because it wasn't that long ago that we were at 7.75 on an expenditure basis.
It wasn't that long
And-
ago that we were
and-
at 4%.
Yeah, because we had a first selectman at the time who was telling us, oh, we should be around 5. Literally was telling our boards that.
Yeah. Well,
So that's what we all thought until we started looking at the numbers again and realized that at least this board did, and with the help of all the other boards, started significantly putting money away towards raising it to what it should be.
Right, which is really clearly strengthened the rating quite substantially.
Yeah.
And I have the trends, and we use them when we talk to the rating agencies, the trends, obviously the analyses that we've seen, and it's an upward trajectory. And at this point, where we were, say, 7, 8, 9, 10 years ago, there was a concern for a reduction of your rating, and it still never happened. Just so, just for context, would I suggest going back down to 5%? Absolutely not, if you want to maintain your AAA rating. Now, that being said, do you need to go to 15%? I mean, that's all your call, as far as the town goes. But as far as where you stand now and where your rating is and where your fund balance levels are and where your debt ratios are and things like that, and the conversations that I've had over the years with the rating analysts, which I've dealt with every issue for the last, 10 or 12 years, there really aren't any major concerns that they have indicated to us with respect to the town's rating. Now, there's been hurricanes and there's been issues with the state financial situation, which we've all obviously become very aware of over the last particularly year and a half. But even in spite of that, the rating is very stable and strong and in very good shape overall. With obviously not just talking about fund balance, but talking about the economy and wealth and the level of activity that's going on in town and the university involvement and all these other things. We weathered the GE move. That was a big deal. It was in the news every day. And the rating agencies, we had a conversation, and they were happy with things. And this is a couple of years ago when those fund balance levels were lower as well. So just to give context, we don't ever recommend saying, try to play down to the lowest fund balance level, because then that is a concern, and we don't want to be sitting here or in the chair when any rating change happens like that. So.
Can I ask a question?
Yes, and I should have welcomed you from the beginning, so welcome, Ms. First Select Woman. Yeah, ask your
Thank you.
question.
Just mentioning, Jim mentioned about the hurricane. I wasn't obviously here. Did we use any of our fund balance when we had Storm Sandy?
We did not.
Okay.
And actually, we're still waiting for FEMA money from that,
Right.
which seems to be getting more speculative about whether we're going to ever see that money
Right.
by the day, it seems
I
to
know.
be.
aware of
Because
that.
we've been waiting
I
years.
just didn't know if we used it.
Years and years and years, and maybe you can give us an update at some point on where we stand with that.
When I
Because
have
it's
one,
kind of getting frustrating.
I hear you. I'm frustrated too.
But
Okay.
to be clear, we're at 10.3. I mean, Matt, you've been part of these conversations when we've had them in the past. I mean, and it's never been something that we're trying to ever be the leader in this category.
Right.
But we're also trying not to be the bottom of the basement either, especially with the fear of something happening. And we kind of have something happening with the fill pile.
Right.
An issue that we don't know whether it's going to cost us $1 million more than the $1.8 million we've spent already, or whether it's going to be something that costs us $60 million.
Right.
We're in kind of one of those situations. And I think we've always, at least the board, when we've talked about this, said we don't want to be, the leader. We don't want to be in last place. We kind of like to be in the middle. And the middle seems to be 13.1, at least with the numbers you've presented here. So I just let the board know, while we are kind of towards the middle of the pack, and it's been a great thing that we've all worked on, all the bodies, putting these monies away, putting these surpluses away that we've had, not just spending the money. I would hate to go below where we are kind of currently.
Well, yeah, I would agree. I personally would agree with Mr. Walsh on that. So can you just speak to the state median and what that means to the rating agencies as compared to where we are?
Yeah, the state median, and I want to make sure we get through some of the other charts too, because your rating obviously is not limited to your fund balance level. And I think a lot of times towns get focused on that because A, it's one of those things you can control on a year-to-year basis from time to time, but also it gets a lot of news and those kinds of things. But the rating itself has so many other factors involved that we want to make sure we look at and discuss And if you look at some of these other towns like a Norwalk or a Woodbridge or a Madison, where maybe they don't have the same the wealth indicators, or they don't have the same economic activity, they have to have a higher fund balance to get into the conversation of a AAA. So that's something to consider too. There's a lot of factors in there that we want to make sure we don't overlook. So the state median in this particular case, this is just overall state 13.1. That particular median is just there for your information. The rating agencies don't really say anything to the effect that it's above or below the state median. The things that they look at and that they'll mention it relative to like the AAA median in Connecticut, which is, just look at the middle, it's probably 11.2 or 10.9. Now, they also look at it relative to the national medians, which is important to know, because they have to have a way to compare across states and counties and different forms of government and different revenue sources. They just need to have an idea of a way to compare those types of communities. And the national median is roughly between 25 and 30%. And the reason for that, and we've probably talked about this over the years, is different revenue sources with more volatility, state tax, and things like that. Obviously, in Connecticut, we get away with having a relatively lower median fund balance level with AAAs because of that stable tax source, which is property taxes, because of the wealth indicators. And quite honestly, you don't get a lot of state assistance either. So there's a lot of factors that go into the fact that that Connecticut AAAs in particular get away with having a lower fund balance, relatively speaking, to the national medians. I don't think you're going to see anyone trying to build their fund balance up to 25% to keep up with the national median, because that would just be, I don't think that would go over well politically. But with respect to, so that's sort of the state median conversation. Do you want to, we could flip through some of these others,
Yep,
and then
let's keep-
or I could stay here.
Hi, thank you.
Thanks.
I'm glad you brought up there's a lot of factors here, right? And
Yes.
these charts are, I think, are very comprehensive, so, and I appreciate that. I like the peer analysis. What I did when I saw these charts is I said, so we're a AAA Moody's, a AAA S&P, and a AAA Fitch, right?
Right.
So I said, well, there's only 3 other communities on here that are all 3, and it's Greenwich, Norwalk, and Ridgefield. And I went through and I circled all of those on these charts, and it's funny because where you talk about, overall per capita income, right? Hey, Norwalk's on the low end, but they're just kicking it on unassigned general fund balance, 14.7%. And Greenwich is the exact opposite.
Right.
So I found that to be a real good comparator. I don't know if that makes sense. If saying the 3 of them makes sense, I was kind of wondering what your opinion is.
I think that's an interesting observation. Absolutely. I will say that the communities that don't have the AAA from S&P or Fitch is just because they just don't go to them. So they have the Moody's AAA. They say, oh, we're going to go with one rating and be done with it, or what have you. So I would say I would feel pretty comfortable that just about everyone on this list, if you have a AAA from Moody's, you're 99.9% going to be AAA from the other 2. You can be a AAA potentially from S&P, and maybe that's not quite a AAA from Moody's. There's different theories on that, but that is an interesting observation nonetheless. But to your point, which is really what you're, I think, getting at, is the fact that yes, you can be a little higher in some and lower in others, and they have a weighting system that they've been more transparent with over the years. And, it's like, it tells you, 30% economy, 10% institutional framework, 30% finances with cash, liquidity, budgetary performance, all involved there. So we kind of get an idea of all the things that go into it a lot more than maybe we did 15 years ago.
And to that point, right, I want to echo one of Mr. Walsh's points. I think that's the real reason that our policy is so important. Our policy is talking about our income levels, our debt ratio. So, even if you sat here tonight and said 8% is totally fine, well, that might not be right for Fairfield. So I think our policy is very important. And as long as we are, as long as we keep reviewing that and making sure that, all these other numbers don't go sideways, I think that should be our guiding principle. We certainly want to hear from you,
Yep.
as much as we can.
Yep.
But I think that's a real reason for that this guidance that we've provided is what we should stick to. And we shouldn't question ourselves, frankly.
No, I think those are good points. And you know, mentioning your policy, the fact that you have one, which is great, obviously, and the fact that you're within that policy range at this point, you know, at the very top end, maybe through the ceiling a little bit if you're talking about available fund balance. And I forget what the language is in your policy, whether it's available fund balance or strictly unassigned.
It's unassigned.
It's unassigned.
Unexcited expense.
Okay, so the point is you're at the top end of that. You're, you know, as far as I'm concerned, based on where your ratings is and where your different metrics fall, it's very stable. And that's not just my own thought. That's based on also the rating agency feedback that I've gotten over the years. And, you know, the last thing I want to see is any issuer that I work with get downgraded, particularly from a AAA. So we want to make sure that, you know, our little piece of this puzzle, we at least do what we can to maintain that rating. Now, that being said, things happen. You have different needs, different capital needs. You know, you go out tomorrow and authorize $200 million for a school project because you need a school, then that's going to push up some of your debt ratios, and that's going to make some of the things not look as good. But the town wants it, the town approved it, and the town needs it. So, you know, we just do our best to hope that the planning and the forecasting and things like that are enough to maintain the rating. But you can't always just work towards the rating as being the only thing that you know, matters, I guess.
Okay. So where are we at here?
So I think we're in the debt section. We just looked at debt service to expenditures. Then the next page kind of goes more into the wealth of the community and wealth indicators, and you have equalized net taxable grand list per capita, and you can see there that you're on a little bit on the higher end there of the average. So you can see that. And a lot of these factors you obviously can't control from one year to the next, but they're just snapshot in time, and they're things that get used, obviously. Per capita income right in the middle of the analysis. So again, we've gone through this and really don't see any glaring deficiencies or anything that's, you know, outlying anywhere. Tax collection rate, it's interesting on this chart. It looks like you're on the lower end, but you're at 99%, and no rating analyst is going to give you a hard time for having 99% tax collection rate. So I can just tell you that.
So Matt, if I remember right, a few years ago, we had a AAA, but we had like a warning, right? Do you recall what that was?
Well, it was, we got put on negative watch some years ago. And I mean, I can't remember what year it is. It's easy enough. I know Kayla and I have talked about it over the years, and I can't remember. I mean, this is your fund balance chart, and it was definitely back here somewhere.
I'm sorry.
I'm just looking at your fund balance chart, you know, going back to,
Was it after Madoff?
A decade.
Mrs. Marmion asked?
it might have even been before that. It might have been, yeah. It might have been around there. Yeah.
Can you just research that and let us know? It's
Yeah.
just something we should
Yeah, of course.
be aware of.
And what year that was and the reasons for it?
No, I don't know. I think something happened with the state being downgraded, then a whole bunch of communities kind of got hit by something due to the state.
Yeah,
But I'm not sure if that's it or not.
There was a big thing with the state. I can't remember if we were on that list. The one that was specific that stands out to me was when we had a situation where I think the fund balance was like 4%, and there was like a capital reserve account, I think was negative or something in the audit. Remember, this goes back some years.
Are you talking about the internal service fund?
Yeah, the internal
I
service.
mean, we were very concerned about that for many years. That's why we've been
Yeah, and the fund balance was
growing
low at the
that.
same time, and
Yeah.
there was a lot of different factors going on there. So, again, maintain the AAA, but those rating calls were a little bit stressful, more so than they are now with the town, because, again, they're very comfortable with where you are right now.
Okay, so other than what we've discussed, when you have those calls, what else do they focus on? Anything that's not in your presentation?
Nothing that really moves the needle, you know, to the extent that it's really going to have a major impact. There's obviously other factors and other conversations that come up. I mean, cybersecurity, you know, things like that. You know, the reliance on state aid, we talked about a little bit, comes up. forecasting what's going to happen 5 years from now or what the debt plans are, and which we obviously show them based on the 10-year forecast that we put together, stuff like that, but nothing really that is completely left off of this analysis, no.
All right, thank you. Any other questions from the board?
Yes, just to follow on, pension funding levels.
Oh, yeah, of course.
OPEB,
Yeah,
are
the
those,
pension OPEB is obviously very important because it's gotten so much press over the years, particularly with the state level government nationwide. Your pension is in quite good shape, so. to
Yeah,
the
it's
ex-
at 85. OPEB's lower, but I think is in the range of, or, somewhere in the range of these communities.
Yeah.
It's at 35%.
Which is relatively good. For pensions, really, the two big components are the fact that A, the funded level is healthy, and B, that the ADEC is getting the actuarially determined contribution is getting made on a year-to-year basis. So that's one of those things where, not to go off topic, but where you say, well, things are good, the pension's good enough, but we're having a tough year, so maybe we'll just put 50% of the ADEC into the budget, and we'll go that way. That's never a fun conversation with a rating agency. They do not like that, particularly with AAAs, because of the fact that it's gotten so much headline press with on the national level. So yes, pensions are very important. I should have mentioned that. Thank you.
Okay, Mr. Walsh?
Matt, you're familiar with the waterfall chart, correct?
Very much so, yes.
You designed it, actually,
Yes,
correct?
yeah, yes.
And why don't you tell everybody what that was designed to do?
It was designed to look out into the deep into the future with a very long telescope and try to identify what capital needs would be coming down the pike and how best to and also how it might fit into your overall bonding and budget impacts and what those numbers might look like going forward and what it might impact various ratios and things of that nature.
And we manage to that. You know that, right?
Yeah.
We manage it. Every project gets put on it, and the Board of Ed has a certain percentage, and if they want to add some project on next year, they've got to move some things to other years. That's the way.
Potentially. Well, every year when the requests come in, we do our best to identify what the size of the bond issues might be that year or the note issues might be that year.
And what are we trying to manage on that? Below 10%, correct?
Below 10% of expenditures is a good target.
Yep.
Right.
Is that a AAA target?
Well, it's a good target to use. I think if we look at the debt to budget and you look at all the AAAs, there's only really one that is glaringly over 10% with New Canaan at 11.2. So I think 10's a number that you can use. There's no real magic bullet there, but I think beyond the number itself is, what have you done historically? What's the plan going forward? If you're at 6%, 6.5% now, is that going to go to 10 or 11% in the very near future? Or if you're, very high, is there some way that you're going to be able to bring it down over time? It does happen where we've seen AAAs and highly rated communities go over 10% and they've maintained their rating. But yeah, it's a good target to use as far as, not wanting to go over that, yeah.
Mrs. Bossi, where do we stand with that number right now? What percent are we at?
Our actual debt?
Yeah.
In which budget? Are you talking about 19? Because that's coming up in the CAFR. Are you talking about 20?
Yeah, why don't we talk about the CAFR first?
Well, the CAFR's on the yellow bar there, so that's about 6.5, 6.6.
Okay, and where are we going with this budget year? Where are we anticipated to go?
If I look at the waterfall chart that I have in front of me, fiscal year 20, we're ending at 25,410
25 what?
million.
And what percent would that be?
I don't know. I would have to do that.
Could you figure that out?
Yep.
I'm just trying to figure out where we are and where we're going. Because the next question I have for Mr. Sperndale is, what is in order not to get over 10%, because we have a little problem coming up with this, and we're going to be told by the first select woman, hopefully in the next couple of months, of how much this whole fill pile situation, where it might be going, and
Right.
what amount of money we're going to have to come up with based on all the people she's meeting, all the experts she's hiring, and what the state is requiring, state and federal government are requiring for a remediation plan.
Right.
And the question is where to get that money, because right now, There seems to be only two sources of that money. Our fund balance and borrowing,
Right.
correct? You don't see any other solutions, correct?
I mean, there could be, is there any, I don't know if there's any
Well,
insurance or grant or
There's,
anything
there
like
might
that?
be some insurance, so.
Some insurance.
But not a lot.
Those are the primary ways you would raise that funding, I would assume, yes.
Okay. So based on the number Ms. Bossi is going to be giving us,
I mean, it's got to be
We
around
can-
6.5% would be my guess, 6.5 to 7%.
Yeah, we're a little over 7% for
Yeah.
budget for 20.
That's
Okay.
budget for 20. That doesn't include the TRB allocation that'll get done when the
Right,
audit
If
happens.
you're looking at gap.
So we're always looking at gap. So you're probably at 6.7, 6.8, 6.6.
okay, so if we took that up, how much room does that give us to get up to 10%? Borrowing capacity.
Again, our general fund budget is like 317, and if you add in our STRB of another 35.
So 30, yeah. So at least 35 million.
Yeah.
And if you're at 25, another 10 million.
So 35 million we could borrow without going over the 10%, and that would
Well,
assume.
35 million would be your debt service for that particular year on your expenditure total, which would be around 350 million when it's gapped out to get to that 10% level. So we're not saying you can borrow 35 million. 35 million would be that level of debt service, which would be roughly 10% plus or minus.
So we
And
could
if you're
borrow.
at 25, so it's about $10 million difference.
So what would be the borrowing amount, not the debt service amount that we're servicing?
I wouldn't be able to speculate on what that would be at the moment, but if I can just use round numbers, you're at plus or minus 200 million. We're using big round numbers. $200 million of bond debt right now. Plus or minus 190, 200. What's the difference? So it's
Yes.
like, so if you added a third to that, you know, or you added another, you know, if you're at 6% to add 50% onto that, that'd be 9%. So 50%, another 100 million.
Okay.
Now that's not to say that that's a good thing that we should strive to
Yeah,
do.
what would be the effects of something like that?
Well,
that max?
the reality of that would be if it did come in and it was $100 million, or if it was just a school project that was $100 million or what have you, there'd be a lot of factors and a lot of things that would come into play if you all of a sudden had a $100 million bill. One would be it would take time to authorize, to figure out what you need, how long you're going to take to spend it. This project might take 2 or 3 years. You're paying off around $17 million a year in principal. So right there, you move forward a couple of years, you've already paid off another $35 million. You know, so you have to think about it in these terms. Just, I mean, nobody likes to say, yes, we could
But-
absorb $100 million.
But that's assuming that we
Do
went
nothing
into
else.
a debt freeze.
Do nothing else.
That the town sends out an emergency signal and tells the Board of Ed
Right.
and the town side, we're not borrowing a penny for those 3 years.
And that's a great point. The point would be that I would hope, I think a taxpayer would hope, anybody would hope, that if you all of a sudden had that $100 million tax bill or capital funding need, you would probably adjust some of those other items that you're looking at down the pike. So it wouldn't be just, well, we're going to do all these other things we talked about and also this other $100 million project. So you figure time goes on, you pay debt down, you probably adjust the waterfall, maybe move things out a year or two or what have you, you know, to make sure that you can afford it. And so as that happens, you pay down debt, you adjust those items, and we don't do a $100 million bond issue right away. We probably wait until the first or second year, maybe do a third of it, then a third of it, then a third of it, work it in depending on what the cash flows might be. And when you look at it that way, it's not just going to push you up to 10% like overnight. So, you know, that's kind of the reality of how it would work. Yes, would your debt service as a percentage of your budget go up? Yes. Would your other ratios go up? Yes. Would that be an immediate red flag for a rating agency to downgrade you? No.
But we also have, and you've probably been told this, the prospects of having to fund a water treatment facility renovation, which we're told the numbers are upwards of $60 million. That's literally staring us in the face.
Yeah.
So when you start looking at that number,
Right.
school projects that the Board of Ed and the students of this town deserve, on top of that, it really starts reducing that $100 million to a lot less that would be available.
Again, potentially. It depends a lot on the timing. And we're talking about potentially 100 million when we have no idea what this cost is going to be.
Trying to get a sense, because as a Board of Finance, we have no money right now. It's like extra money until hopefully we run a surplus this year
Right.
to throw at this, and they need money shortly, since we're pretty much giving them the whole $1.8 million we had already assigned from the surplus from last year, basically.
Mhm.
So we're just trying to figure out, and it's one of the reasons you're here tonight, is to kind of start getting a sense as a Board of Finance. And I'm not trying to speak for the whole board, but it's one of the reasons I wanted to hear from you, to try to start getting a financial sense of where we stand, because the numbers that we're looking at, especially with this fill situation, are kind of scary. And knowing
Right.
that we have a water treatment facility that we've been told they're going to be looking for approximately $60 million. We
Now,
need
is
to
that
get-
is that all on the burden of the taxpayer, or is that
Well, we haven't figured that out,
self-supporting?
and that's going to be something that's
There's a
going
lot
to
of-
have to
lot of
happen over.
variables. Yeah.
You know, we're going to see what's going to happen with that, so. Okay. Thank you.
All right, thank you, Mr. Walsh. Anyone else from the
Just
board? Mr.
real-
Prestani?
Yeah, real quick, just a quick question. Toward the end, I'm just curious, with regard to the improvement on the tax collection rate, you said was at 99.8%, but yet some are at 100. I'm guessing that doesn't influence the AAA credit rating all that much, even though we're toward the lower end? Is that fair to say?
Yeah, I mean, we're kind of looking at it through a microscope at this point, because the scale is so tiny, but you're on the lower end of that tax collection rate relative to these other communities, but you're at 99%. And I don't even think it's ever even come up in conversation with the rating agencies that would be any kind of a concern.
And the only other two quick things are, on the equalized net taxable grand list, our grand list just increased pretty dramatically. So this was from this last fiscal year, correct?
Well, right, and
So will
if
that-
if you, I know where you're going with this, but the equalized grand list is that number that comes from the state. So what they're trying to do is equalize all the towns across different cycles of revaluations. So their number kind of assumes on a year-to-year basis that you're adjusting for your value that particular year. So your grand list per capita, if it goes up, will go up. But the equalized grand list, again, because it's that number from the state, doesn't really jump that much from year to year, because again, they're trying to stabilize everybody for comparability's sake.
And last question, it surprised me a little bit, on the annual unemployment rate for Fairfield, only Norwalk was higher for unemployment. That kind of surprised me a little, given Fairfield's standing in the community and Fairfield County. So just curious, how much does that weigh in the credit? Again, not much.
Not too much. I mean, it's kind of part of the overall picture of the economy. But if you look at Fairfield, Norwalk, larger communities, so you have potential to have slightly higher. We're talking increments here. We're talking like you're at maybe 3.6, and all these other towns that are sort of in the middle are at 3.1, 3.2. So it's not, again, it's on the higher end, but it's not an outlier at all. Like as if you were 7% and everyone else is at 3.5. So I wouldn't worry too much about it. Yeah, we never want to compare to anything to them. But yeah, you're absolutely correct about that. Yeah.
Okay, anyone else? Thank you very much. We appreciate the presentation and the information. Oh,
Oh yeah.
Can I just ask where that unemployment number came from?
Uh,
Because we have a schedule in our CAFR that has it at 2.7. So I'm just-
This is the annual number that we get through the fiscal indicator number that would probably have been for like last year. So it's probably somewhat stale, but it's also lagged for everyone. So a snapshot in time. One thing I would mention is that we all know that we're doing the refunding of some bonds. And so, on a bright note, we're looking at interest rates that are the all-time low, like literally. I don't know if anyone has been watching that. Unfortunately, the last couple of days in the equity market haven't been good for anybody. But from where you're standing, as far as the refunding, we're looking at hopefully, $1 million, $1.2 million, $1.3 million of savings that we'll be able to spread. So
there's definitely a lot of positives, no doubt. It's the uncertainty that can keep us up.
right. Well, of course,
Right.
absolutely.
So thanks for your presentation. Mrs.
Absolutely.
Kupchak. Thank you. You have anything else to add? Okay, thank you very much.
for allowing us to.
All right. Yeah,
Sure.
thank you very much.
Appreciate
Enjoy
it.
that.
Have a good night.
Okay, thanks, guys.
Thank you. Okay, our now item number 2 is to review the performance of the town's pension and OPEB funds, and we'll bring up Mr. Brackfeld.
Thank you, sir.
Good to see you again.
Thank you. It's deja vu.
Deja vu.
The only
Just-
difference is that
You're
it's
over
been
there?
about 5 years, and I've lost all my hair, and you guys, it's all the same. It's a little unfair.
Oh, come on. You'd lost some before that.
Yeah, that's true. It wasn't there. We go back to the videotape. You're sitting in my seat, Lawrence. Thank you very much, and I appreciate you jiggling around the schedule. I'll be very brief with, and just to try to answer the questions as they come. Normally Brian would be up here, so give me a little bit of slack. I'm a amateur. It seems to me there are two things that we should talk about briefly. One would be the performance of the pension funds and the OPEB, and then 2 would be a nice piece of news that I have to report to you guys. So, do you guys get? So my suggestion is, and again, you guys can do it any way you'd like, is we ignore they did send out the January, but why don't we just go to the end of year December, right? Because we don't want to get that picayune. And you'll see it was a terrific year. Geez, I didn't even take these glasses off. The print is tiny. The pension fund returned about 16-odd% last year, and the OPEB did quite a bit better, about 21%, right? And obviously, that's a huge outlier from, where these markets normally are. If you look more meaningfully, in my opinion, back, say, 3 years, 5 years, you start trending down towards the 7% assumed rate that we use on the funds, right? So if you go to 5 years, it's returned 6.52%, and 7 years, 7.62%. And on the OPEB, the history is not as long, because you guys know in particular that we only started funding the OPEB about 5 odd years ago, and the OPEB results are a fair bit better. So the question you might ask is, why are the OPEB results better than the pension results, right? And it's actually fairly simple. The OPEB is a newer fund and a much smaller fund, and so the pension board decided to manage it far more simply, so to speak, with the intention as it grows to a bigger fund to morph it over to the allocations of the pension fund, which is kind of interesting in its own way, because it's performed so much better. Why would you do that? So the OPEB has a far higher relative amount of stocks, both domestic and international, whereas the pension fund has got a lot of oddball stuff, hedge funds and private equity, real estate, commodities. Yeah, Jim?
Just going to mention that we have been told over the past couple years by Brian
Yeah.
that once the OPEB market value was over 50 million, that the pension board was going to take a look at these funds and maybe spread them out or do things differently.
Right, right.
But maybe we shouldn't.
Well, that's a very,
Maybe after the last 2 days, we should.
Yeah, well, yeah. Well, actually, I would argue, it's funny you said that, Jim. I think the last 2 days, while not pleasant, are perfectly instructive as to why you have a diversified portfolio, right? And so the equity markets have been raging for a while, and then all of a sudden, like that. But don't forget also, December of 2018 had the biggest drop in any December in history. People don't remember that. It dropped 20% in a very short time and then snapped back very quickly, which also makes last year's 30% a little suspect, because it was coming off of a 20% down December. So let me defer that question, because I think partially what I'm going to tell you next will sort of answer it, if that's okay. So before I talk about the super news, is there any questions about the performance or the makeup of the funds that I can help you guys with?
And maybe it's an indirect question, but when we were reviewing the financial statements at the audit subcommittee earlier and looking at the actuarial calculations, and we have this 7% long-term rate of return baked in, what time horizon is long-term for that 7%? How many years?
Well, I can give you both an opinion. I don't know a factual answer to that. My opinion, it's infinite in a sense, because a pension fund should be managed for a virtually infinite time horizon.
Right, but we have a period of
So-
time until which we're paying out benefits, right? So I think we showed, in the analysis that the auditors put together, they showed 6 years of history, which came out to an average return, and there was a lot of volatility of something like 7.5%.
Yeah, well, we just
The
looked-
long-term
yeah.
rate that was built into the plan was 7%, but I don't know if should we be looking at 6 years or the
Oh.
last 10 years, or how do
Okay,
we
well,
think
that's-
about that?
Yeah, well, that's a big question. First of all, it's something we discuss a lot at the board, and you guys, I think, discuss it a fair bit too, and you also probably, when, Hooker and Holcomb comes, they probably will talk about it a lot. You know, I mean, I wouldn't be telling you anything super brilliant that it's been a major feature of the news. Not as much last year because the markets were so high, I don't think people were talking about it. But, you know, across the country, you have pension funds. I mean, 7% is actually fairly responsible, right? There's a lot of funds that are still out there at 7.5%, and I've even read about some that are still 8%, which is highly unrealistic, especially if you have a diversified portfolio like we do, right? We have stuff in the portfolio, fixed income, for example. You know where current interest rates are. The chances of fixed income returning more than 2 or 3 or 4% going forward are virtually impossible, literally impossible, actually. So if you're going to have 20, 30% of your fund in something like fixed income, which you should, because it provides ballast, it provides safety and security, then, you know, unless you think you're going to have these crazy equity returns like we had the last year, getting 7, 8, we'll call it 8% is not going to happen. I'm giving you a kind of a circuitous answer because it really is, it's a best guess, right? It's not a.
Yeah, I guess I'm not sure if I'm remembering this correctly, but I thought when you look at a discount rate on the pension liability, right, you're looking at a discount rate over a time horizon that's supposed to match the, remaining
Fair enough,
service
fair
period of
enough.
employees, right?
And by the way, there are other sides to it too.
So
though. Yeah.
should the asset side match that in terms of number of years or generally, or are we
Well,
looking at something else?
You know, I'm going to plead the fifth a bit, number one, because it's not my area of expertise, number one. I think Hooker could give you a better answer. However, I will point out that we moved, and maybe you, oh, they're gone. We moved away from this defined benefit plan, right, for all the new town employees going forward. So your question is actually very apropos, because for a large part of this plan, it's actually going to literally sunset. Right. Now, the other point I'd like to make is that everybody focuses on the 7% correctly, but you have other side of the coin too, which is the benefit side, right? And for example, most of these funds, including ours, probably has an inflation rate baked in that's too high, which is good, right? Because it's assuming the benefits are going to grow faster than they probably will, because we're experiencing much lower inflation in the economy than all these forecasts have been. So it's, you know.
No, thank you. I just, if we think about that or get our heads around that, it would be nice to just show that comparison on a rolling
Right.
basis.
Right,
so we can-
and also remember, this is also not a secret, to the extent that the 7% number is ratcheted down, it means the town has to put in higher contributions, right? So it's always a, there's no free lunch on it. It's a question of when you pay it, actually. Anything else on the?
Any other questions? Ken, you used to ask great questions
I
when it came
appreciate
to
it,
this,
yeah,
so
yeah.
if you were here, what question would you ask?
Well, okay, thank you for giving me that opening, Jim. The brilliant people of the pension board would like to announce. No, I want to give Brian a bit of a shout out because he has done a really terrific job as chairman over the years. Very dedicated, works hard, and he actually drove the discussion primarily on a decision we made at our last meeting, which is going to have a major impact for the town and for the fund. So we've been operating as a fiduciary pension board for as long as I've been doing it, meaning volunteers from the town are going to the meetings, and we're actually selecting the investments, right? We have Callan, who's our current advisor, and they will, we take their advice quite literally and very seriously, but at the end of the day, we're the ones who select. So if we decide that we want to boost international equities by 5%, we'll say to Callan, could you bring us 3 managers in that you think might be a good choice? Those 3 guys come in, they make presentations, blah, blah, blah. And, it's very tough for a group of volunteers, And not everybody on the pension board is totally experienced in the markets, right? And it's very time consuming, but if I don't have to tell you guys this, you have meetings that go to 12, 1 o'clock during budget season. So there's a different format called OCIO, and you may ask, what does that stand for? It stands for Outsourced Chief Investment Officer. And it's really the trend that these public pensions have been going, meaning instead of having our group do all that legwork, instead our co-fiduciary responsibility to some extent becomes limited to our choice of the OCIO manager, and then we're asking them to do a lot of this stuff for us. And Ms. Bosse can chime in on this. You were at the meeting as well. Bottom line is that after interviewing six different managers, including Callan, who's our current manager, we selected Vanguard, what everybody here has heard of. Vanguard is the absolute leader in low-cost investment providing advice and funds. And we selected them to be our new OCIO, it's going to be hard saying that, provider. And I don't know what the exact timing of the implementation is.
I think the Callan contract runs through April, May.
Okay.
So we were going to let that go.
Got it, yeah. And we have a meeting tomorrow night. So the bottom line is I just scratched down a few things that, and here's the one that you guys should care the most about. The interesting thing is that Vanguard will be upping the services and lowering the costs, and a lot. So believe it or not, on a fund our size, by dropping the average fee from 0.5 percentage point to 1/4 percentage point, over 20 years, if you compound out that value, Mr. Walsh, what do you think that saves the town? In real hard dollars. Well, that's not bad. $79 million. Yeah. What people, 79 million. Now, then bear in mind, that's the reduction in the fees. The reduction in the fees, and then those reductions are reinvested in the market. So it's the compounded value of the reductions, right? Real money, by the way. And now, of course, that assumes that the market return is equal in both cases. Okay. So I would argue that I personally like Vanguard's philosophy better because it's a lower cost, more passive philosophy. So I would argue it might even do better than that. But the 79 is an actual hard number. And over, what is it, even over shorter years, where is it? It's about 20 million over 10 years, 43 million over 15 years, 79 million over 20 years. So it's just, it's just good news all around.
Mr. DeWitt?
So I had a discussion.
And there's a few other things, but go ahead. Yeah.
No, I want you to finish, but
Yeah.
I had a discussion with one of your board members about this a couple months ago, because this is a great idea. But the one thing that I think you're missing is OCIO, there's a fee. So today, there's no fee. We have a bunch of volunteers, it's nice. But what you're saying is, even with the fee,
Yes,
we're
right.
saving $79
Yeah,
million,
no,
right?
That's all
which is
inclusive
great.
of, that's inclusive of Vanguard's fee
Right.
and the assumed fees on the investments. Now, as long as we're at it, and this, I think Caitlin could speak to better than I can, we also have administrative expenses that we pay to peoples, right? And Brian, who's much more expert than I am on that kind of stuff, his eyes almost popped out of his head when he saw Vanguard's estimates for what they would do those same administrative charges for. So there's a lot of money to be wringed out on the fee side of this. And hang on, Jim, just me. So just a few other things that I thought were interesting and important were, obviously, it's a huge advantage in fees. We pick up the co-fiduciaries. So basically, they're adding their fiduciary responsibilities on top of ours. And I think, personally, that this will make it a lot easier to attract board members, right, who no longer will feel that they have to go to the grind of these meetings and have to sit through listening to long presentations from these different managers with PowerPoints and the whole thing. And to be perfectly honest, it's all sales pitch. They're all the same. And also, since when we make investment decisions, we have to have a monthly meeting, and we have to talk about it and decide, and sometimes it takes several meetings. These guys are responsible for implementing those decisions. So if they decide with our agreement that we need to make an adjustment, add something to private equity, reduce international equities, add to fixed income, whatever, it'll be done literally that same day or the next day. So all good stuff.
Yeah, all excellent. And you get to bring it to us.
I know, this is a very good timing, I know.
It's good
yeah.
time. Mr. Walsh, you had a question?
Fiduciary, yeah. The way
Sorry.
yeah.
So you make these decisions together, or do they make
No.
all the investment decisions?
I would say the best way I would describe it is that it changes the fiduciary responsibility of the board from currently being responsible for picking investments and so forth to more like our responsibility is picking Vanguard,
Okay.
right? Which doesn't mean, by the way, that they are going to just choose some cockamamie, portfolio and just, shove it down our throat. That's not the way, it's still going to be a co-effort. But I think it changes, as a board member, and you guys as well, there's a fiduciary risk sitting in the board. And to have a firm like Vanguard willing to take that fiduciary risk along with us tells you a lot about the confidence they have in their product. And last thing I'll tell you is their numbers. I mean, they're huge. Where is it? They manage over $50 billion in assets under management, 95% client retention rate, all that good stuff. So, don't have to sell Vanguard.
How, if Vanguard's acting as the outsourced chief investment officer, what is going to happen with decisions in regards to us putting money into Vanguard? Because under the town's pension plan, we're only in their international fund, about 5%, but on the OPEB, we're into them for 70%. Right
Good
now.
question. So, yeah.
So how does that work so that Vanguard doesn't get
Right.
100%?
Right, good question. So, that's a good question. I'm not sure. Formulate an answer for you. The first answer is that they have a fiduciary responsibility. They have a legal fiduciary responsibility to act in the interest of the pension fund. That's number one, and that's important. You're a lawyer. Number two, Vanguard doesn't only use Vanguard funds. They access Vanguard funds, Vanguard active funds, Vanguard passive funds. They've also started a private equity department because that's important. Private equity is a big part of all these pension fund investments. There's no reason to expect that if there are two funds that do essentially the same thing and one charges less, almost certainly Vanguard will be the one who's charging less.
Okay.
But if they're not, they have a fiduciary responsibility to put us in the one that is in our best interest.
Okay. I'm more concerned with what the investment weights are, and that
Yeah.
those are getting the best investment returns
Right.
in the market, I guess, because especially on the OPEB, because we're currently 70% of the fund is invested in Vanguard.
Yeah. So my suggestion is don't get hung up with Vanguard as the name. Those are index funds. So Vanguard runs index funds. iShares runs them. BlackRock runs them. Fidelity runs them. Schwab runs them. They're literally cookie cutter products that are price. We selected them because of the price. If Blackstone was offering the same fund at 1 basis point, meaning 1/100% lower, we would have chosen them.
I guess the question is as the co-trustee, are
Right.
you watching out for that? I mean, are you looking at it and being like, hey, you know what? Why aren't we in the BlackRock fund? Why are we so heavily invested in the Vanguard fund? Because
Yeah.
I'm just taking an example. I'm not saying any of this is true, but 70% of our money's there, and the BlackRock fund's been outperforming the Vanguard fund. Same type of, index funds
Right.
for 3 years consecutively.
Right. So the
I guess I understand why they're trustee, but are you guys as co-trustee going to be kind of testing that out over time.
Yeah, the answer is yes. And the other answer is that the beauty of index funds is the only reason the BlackRock fund, in your example, would have been outperforming would be a lower fee. Okay, so yes, it's our job and their job
Sure.
to make sure we're not overpaying. Now, what happens in this business, for what it's worth, if you follow the news on this at all, is that they're constantly in a battle lowering fees. The fees are all going to zero on these funds, by the way, which is interesting. And so obviously, we can't be hopping in and out of these funds every day. So it's something you evaluate over time. But if it's clear that Blackstone or iShares is offering the same funds at a lower price on a consistent basis, we would access those funds.
Great.
Yeah.
Now, I just want to make sure there's some type
No,
of
it's a great
check and
question.
balance on the
Yeah.
on the system because
And also, you would expect, going back to Jim's earlier question, in spite of the fact that the OPEB has outperformed the pension, you should expect to see the OPEB to start looking like the pension over in the near future because it's gotten up to that amount. And, if you ever read any of the ads in the financial papers, they always say past performance has no bearing on future returns. The truth is that that's accurate. And the fact is that the OPEB has been very heavily in stocks, so it's outperformed. But that could easily flip over. As of the last 2 days, it has flipped over. Right.
is part of our making them our outsourced chief investment officer, are they more likely to take on our investments in OPEB immediately to diversify them, similar to the pension fund diversification? Because we were told by Brian that so certain funds, they just didn't want to do it unless you got to like $50 million. That's why I'm glad he brought that up, because we've been kind of waiting, and the
Right.
fact that the investment
Right.
return has been so high
Right.
has kind of put us there earlier than
Right.
we
Yeah, it's all good news.
we anticipated. We thought
Right.
it'd be like 2 or 3
Right.
years.
Right, so Vanguard, one of the things they told us is that part of the cost savings and part of the efficiencies will be melding the two together. And so the answer is yes. Yeah.
Thank you.
Yep.
Okay, thank you, Mr. Walsh. I do not. Go ahead.
And Jim asked basically what I was going to
Yeah.
ask, but are we, and forgive my newness, but are we in their Vanguard or the other funds in, are these retail funds that we're in, or do we have, we're not, we have special funds that have, okay.
We wouldn't call them special, they're institutional funds.
Right, they're
Yeah.
institutional funds that,
Right.
okay.
Right. When you have certain balances, you reach what they call break points.
Right.
And then you get to go into I think Vanguard, as an individual, you can go into their regular, their Admiral shares.
Right.
So they have something like that for institutions.
So we have the equivalent of that, and is there any benefit, is some of the benefit we're getting in fees that, are we getting any benefit beyond what we're currently getting now?
With the OCIO?
With Vanguard. Like if we meld the OPEB and I mean, if we just are a
Yeah.
bigger customer,
I wish I could tell you yes on that. I think, like I said, the fees on these, especially the index funds, are so rock bottom. My guess is that the good news is we're in at the lowest possible fees. I don't think adding the OPEB will make much of a difference. Yeah. But the OPEB will benefit from being part of the bigger pool and therefore get the lower fees as well. Yeah.
Okay, any further questions? Ken, thank you very
No,
much.
thank you.
Come
And
back
I-
anytime.
Yeah, and I appreciate moving me up. Have a good night, guys.
You too.
Great seeing you, Ken.
Okay, so where are we here? We're on item number 5. Item number 5, to consider and act upon the following resolution as recommended by the Board of Selectmen. If you guys see this, this is basically a grant, so I'm going to make a motion to waive this reading. Can I have a motion? Mrs. Murray and Mr. DeWitt. Okay, all those in favor? Okay, very good. So who's going to speak to this? Mr. Carey.
Generic speaker, Frank Carey.
Hello.
You are like an
Hello,
ex
Brian.
officio to the.
I
Board of
know.
Finance.
Not just you guys, though. I like to spread it around.
You'll be invited to the holiday party.
I've learned not to print the agendas anymore when they're 521 pages for each one. So now I bring my laptop. But Real quick, this project went out to bid. We received funding in 2016 from FEMA. The total project cost back then was $463,000. FEMA was the FEMA grant was for $347,250. Town match was $115,750. We went out, designed the project, went out to bid in 2018-19 timeframe, came back over the amount that FEMA had basically given us, so we had to ask for an extension. That took over a year to get from FEMA. We went out to bid on the project again based on our contract documents that have been provided to you. Project budget is now $717,900. FEMA has not adjusted the grant amount, so WPCA has picked up the difference in the project. The town share is now $370,000, and it's coming out of the WPCA budget. We stand to lose the grant if we don't have this done by June 30th. So we have everything ready to rock and roll. This is one of 2 generator projects grants that we received from FEMA. The other one is moving forward right now for the Mill River Pump Station. This generator's for the wastewater treatment plant and is associated with the microgrid.
Okay, thank you very much. Any questions from the board?
Sorry, one quick question. Brian, thank you. It looks like we picked the low bidder, Holzner,
Yes, we did.
717,000. Just flipping through here, there's a different number on the bid
Yeah, I don't.
schedule that follows that.
That was for another project. I don't know why that was put in here.
Okay, the 738, because it's not the lowest bid on the other
That's
schedule.
correct. That's another project. I don't know why that was added into here.
Okay, it says generator and
Yeah.
ATS on the top of it.
Yeah, the actual contract amount, which you can see in the backup, is for $717,900.
Okay, thank you.
Okay, thank you. Somebody read the 516 pages. Yeah. Okay, any,
I'll make sure to cut that down in the future, because that's.
any other questions from the board? Okay, then I will take a motion to put this resolution as recommended by the Board of Selectmen as written on the table, Mr. DeWitt, and seconded by Mrs. Marmion. All those in favor, say aye.
Aye.
Opposed? Okay, it is unanimous. Thank you very much.
Thank you.
Okay, we're on to item number 6, to receive and consider the comprehensive annual financial report, the CAFR, for the fiscal year ended June 30th, 2019, as prepared by PKF O'Connor Davies, LLP. Mr. Santafonte, welcome.
So everybody has the presentation already? All right, good. All right.
Yeah, so we'll just turn it right over to you, and we'll go through this. And I'll just say, I think it's best in this case, if the board has any questions on certain pages that we ask as we go through the presentation, that's okay with you?
Yes.
Okay.
Yep. So you want me to just walk through this
Yes.
like normal? Okay, all right, great. All right, thank you. So we're going to talk about the 3 different documents, the CAFR, the federal and state single audit, and then our required communications, which is the separate letter, and then we'll talk about future considerations. Okay. I assume it's still on. All right, just need to talk into it. Okay. Notable items in this year's CAFR, general fund balance increased by the $1,361,000. Unassigned fund balance as a percent of expenditures was 11.28%, up from 10.88. Pension plan funded percentages. The pension plan was the town plan was 86%, police and fire about 87%, OPEB for town is about 40%, and police and fire at 31%. And if we'll look at there was a prior period adjustment recorded for the library endowment funds that hadn't been previously recorded. So we can look at that. So it's the last page of the footnotes. So opinion on the financial statements on pages 8 to 10. As we discussed in the past, section headings talk about level of responsibility. So there's the opinion on the financial statements is unmodified, which is the type of opinion you're looking for. As far as the other information in the report, the required supplementary information, we give limited assurance on that. The supplementary information, the combining schedules, we give in relation to opinion on. The introductory section and the statistical section, we don't give any assurance on those two sections. The MD&A,
Joe, I'm sorry. For those of us that are getting older and the hearing's going, can you?
all right,
Yeah.
I'm still not loud enough?
I think you need to move it a little closer,
All right.
unfortunately.
My. All right. Is that better? Okay. So MD&A starts on page 11, goes through page 20. Again, this is a good executive summary of the financial highlights and discussion of the changes in the town's operations as compared to the prior year. The first 5 bullets of page 11 talk about the major activity, the general fund, that activity, changes in the government-wide information. Current year changes, general fund balance, as we mentioned, is at 11.28%. Cap project funds, the activity there is discussed on page 18. There's also discussion again of the internal service funds, which we'll look at in more detail on page 18. The general fund budgetary highlights, which will be some discussion of some of the transfers that were done. And also on page 18 and 19 is discussion of the major capital asset activity, changes in construction in progress, and other capital asset additions. And then on 19 and 20, long-term debt changes, which are also in the footnotes. So going to page 24, Exhibit C, the unassigned fund balance was $34,688,000. Again, heard a lot about the rating agency guidelines and some of the other variables around fund balance. And then you could see your trend where at least the last 5 years going from the 8.53% to the 11.28% of budgetary expenditures. The next slide just walks you through the change in unassigned fund balance from 2018 to June 30, 19. The net change in fund balance to the $1,361,000 and the decrease in cancellation of encumbrances, so that shows up as assigned. Since that number went down, that change goes to unassigned, which brought you up to the $34,688,000. So just looking at, if we're looking at the RSI number 1 through 1A through D, again, that's the detailed budget and actual as comparing it to the GAAP basis. And the main differences are the on behalf pension and OPEB payments of $27,574. The 28 for expenditures, that's the same OPEB difference plus the change in encumbrances. And then that gets you to what your excess of revenue over expenditures are as compared. So again, that's just reconciling the budget to GAAP information. All right, I think that page is in there. So in the MD&A, now one of the schedules that had traditionally been in the audit report, GFOA, your certificate program said they didn't really want it as a schedule, so now it's presented in the MD&A on page 17. So that kind of walks you through the same information as far as the operational changes. So this gets you to the net increase in fund balance, and that was, again, revenues were in excess of budget of the 1,506,000, plus you had savings of the 1,040,000, and that gets you to the 2.546 increase in your budgetary fund balance. And then as compared to your gap fund balance is the 1,361,000. So this is just giving you information how to reconcile those two things. Page 10 is a chart we've been putting in for the last couple of years. It looks like what Exhibit B is, but this is on the modified accrual basis. So this is, if you look at the last column, it's basically calculating the net tax cost of services by the functions. So the Exhibit B is on the accrual basis, so it's kind of distorted. This is on the same basis as your budget, the information coming off of RSI 1. So it just gives you a different perspective on what your expenditures are, and what's supported by something other than taxes, and then the net amount supported by taxes. Next two pages are just your fund balance trend in chart form. The first one being in percentages, going from the 8.53 to 11.28. So I think I took out the dollar ones. Again, just for perspective on which you already talked plenty about fund balance. So I wasn't realized Matt was going to be here and go before me. I was going to left this one out, but there's that information also for you. The internal service funds, just looking on page 13, looking at 2019. So change in net position was a positive 491, so it brings your total net position up to 828. So as we mentioned before, the rating agencies back in 2015, when your net position was negative 2.3 million, had a lot of questions. So now that it's positive and your current ratio is in good shape, that shouldn't be in any part of the conversation anymore. So looking at your operating income of the 491, the operating income was 721,000 less than prior year due to the increase in medical claims and the incurred over the prior year. So it was a decrease in claims that kind of drove, as compared to prior year, your positive results. The pension funds, so the combining pension and OPEB statements are on pages 32 and 33. Those are the combined information. GASB requires combined upfront and exhibits. The actual separate funds are in the footnotes on pages 88 and 89. So you can see each fund individually. And then there's a lot of the required supplementary information schedules starting on page 96 through page 103 for each of the plans. So you have the two employees plan, the police plan, and then the Connecticut State Teachers Retirement information. Again, that's disclosure only at this point. That was the liability or the contribution that the state has been looking to push to the towns. Page 16 is, again, looking at the rates of returns. What was mentioned, this is the 6 years, and it's 6 years only because that's the amount of data that we have on the RSI schedules. Again, it is supposed to be a long-term rate of return, and hopefully the actuaries can tell you what they look at, but this is just to give you perspective over the last 6 years, how you compare to the 7%. So normally it is a longer-term view than the 6, but we're just presenting what information we can, just to give. So at least over the 6 years, you are hitting your discount rate. And page 17, just giving you some data and comparing 2018 to 19 for each of the pension plans. So what's your net investment income? How much of that was changed in fair value? Where your benefits are, the rate of return. So benefits on this plan are up a few percentage points, 1.14 as compared to last year. Your funding ratio for this plan went up by, 0.6. So we're on the increase. For police, similar information. The benefits there are up 0.23%, and the funded ratio went down a little over 1% last year. So still very good percentages as far as where you want your pension plans to be. Again, just a chart that gives you some perspective on where you fall compared to a few of the other towns. Obviously, there's always a lot of factors behind this, but again, your percentages are on the right track. For the OPEB funds, the liability for towns, 39 million, police and fire is 53 million, Board of Ed is 17.7 million. The first two decreased in the Board of Ed plan because it's not a funded plan, it increased last year. So you're making pretty much 100% of what the actuary is asking you to do. So that's key, as Matt mentioned, is you make the contribution as recommended. So there's no questions from the rating agencies. And again, the funding percentages are both increasing. So again, good trend there. So same charts for the OPEB funds. As you can see where the benefits are going down. OPEB funds are still functioning different, where most of the benefits are not really paid directly out of the fund, but out of the but are accounted for in the fund in the financial statements. So again, having a good year and changing that position of the 2.5 million. For the employee plan, and for the police plan, some results changing that position a little bit better at the 3.265.
Hey, Joe, just a question on page 23. Do we not have data for the police and fire for the other towns?
Yeah.
Is that what that is, or do they not?
It's, a lot of towns don't separate their plans, so that's the reason we didn't. As far as these towns are not comparable from that perspective, where everybody's in one pension plan versus having two plans. So there's I could have found other comparatives that are much smaller. So I just put the data we had. If you want other data, I can certainly get.
Just curious.
Addition. Yeah. $7 million, right. Investment return is going to be, right.
So at some
Right.
point, to
Yeah, no,
repeat
you
myself on the microphone, at some point that should go down to zero with as long as investment, we don't get hit in the investment market's too hard. But at some point that should go down to zero.
The liability.
Yes.
Yeah, it's similar to the pension once you get enough assets in there,
Yeah.
but so that's a long-term funding, probably another 25 years.
Yeah. Okay. And do you know where we stand in regards to our percentage in regards to the, what did you say? We have, so the OPEB funding perspective, we have 38% funded. And New Canaan is one of the highest at 62.7. Is that correct?
Yes, yep,
But I presume there's many towns that are well below us?
yes, a lot of towns are not even funding, so that's probably a higher percentage, not necessarily in Fairfield County, but in general. There's a lot of towns that don't even have the trust, and the liability is just accruing.
Yeah, thank you. And we talked about this in the audit subcommittee meeting a little bit, but has there been a strategy to get that funding percentage up through our budget over the years? Or is this just happenstance given investment returns and?
I thought we funded whatever the ARC is on it, at a minimum.
But
And
that
investment
is meant
returns.
to get us to where, though?
I think it's to get us fully funded. I'm just not sure the number of years that's fully funded. Was
So
that
it's over
25
some
years or
time
something like that?
horizon, okay.
Joe, do you remember that?
Normally, it's a 30-year amortization
30-year
period, so if we're
amortization.
6 years in theory.
So we're 6 years in, okay.
yeah.
Not too bad for 6 years in.
And then this B of E, the Board of Ed, this is non-teachers? This OPEB is
Non-teachers.
not teachers, so this has nothing to do with the state
Right.
plan. This is our liability, and why do we not fund this? Was that just a decision that was made, or? This is not funded by the state?
That's
It's fun-
correct.
I
this
thought it
is
was funded
the
by the
town.
state.
So the teachers are funded by the state, and this is funded by the town?
That's the way I understand it, Joe.
Isn't that the obligation that the state has been supposed to be funding but wasn't funding for years, and that delta number we keep talking about every year?
I thought the state funded the teachers, OPEB. And I thought this was employees other than teachers, so all the others, personnel, non-certified personnel or whatever. That's what I just wasn't sure. And, obviously that liability is going up, it's not funded, so I wasn't clear on why.
Mrs. Bossy, that's correct, right?
As far as I know, that is, yeah. I gotta look into that a little bit more.
As
I'm
far
not
as I know,
sure.
that's
I think if we
correct,
just
too.
do is pay as you go, and I'm not sure where that decision ever came from.
Yeah, and that was my point of curiosity, why we have a strategy to fund the town and the police and fire side, but we're leaving this piece unfunded.
I thought it was because that stuff comes from the Board of Education budget, doesn't it? And we're requiring them to pay as they go. We give them a number, and they put it in their budget. Is that not the case?
Well, it may be, but why is it a different approach than the town?
Well-
Because pay-as-you-go just kind of,
I think it would probably require the Board of Education's budget to go up. Because then you'd have to they'd have to be paying the ARC on top of it.
right, so they'd be doing what the town is doing.
Yeah,
We've not done
that's what
that
that's what I
because-
think.
Well,
Maybe Joe can put some perspective on it, or has a better memory than we do.
I'll try, because
Okay.
it's mostly theory and accounting, so the one thing we need to confirm is if the Board of Ed non-certified are in the town calculation, which we can look at the data and figure that out, so I'll have to look at that. But most of the liability for Board of Education is what we call implicit rate subsidy. It's for the teachers that have left the district but are allowed to plug into the district's medical plan. So because GASB says there's a theoretical liability because the teachers plug back into the medical plan at the blended rate, the same rate as employees pay and not at age-adjusted premium. So older employees' insurance costs more, but they get to pay the blended rate that all the active employees pay. So GASB, in their wisdom, says, well, that's an implicit rate subsidy because they should be paying more because they cost more. So there's a calculation of a liability for that window that the teacher plugs in. Once that teacher goes into the state plan, because that's where they're actually going to get direct benefits, then that liability goes away. So from a cash flow standpoint, they're paying for that insurance every month. They're not paying the age-adjusted premium. So for that portion, it doesn't make sense to fund it because as soon as they go into the state plan, there's no commitment for the town. So that's why it's not funded. If there is a piece that for non-certified, then that piece should be looked at and funded. But you can verify, we'll look at our data, or the actuary clearly will know if the non-certified are in the town employee plan.
Yeah, that was we didn't think this was teachers. We thought this was the other employees.
But
And so we need to verify that, because I think that that's the other, and we know the teachers aren't funded. We know that piece, right? This is the other Board of Ed employees, and, you know, it's just a question. I mean, it's something that can be considered. You know, obviously it costs money to do that, and you have to fund it up, but it's just odd that it's treated differently for that group of employees, so.
Well, it's because most of that liability you're never going to have to pay, so that's why.
Again, we're talking about non-teachers, out of the state plan. So those individuals, maybe they're included in the town plan, but I thought these were budget basis financials. And I thought that these were, at least what I was told, was that these were non-certified employees that were here. So I get the piece you're talking about. We're talking about something else.
You're not, it's both. The Board of Ed number, if the non-certified in there, it also includes teachers who have not retired yet. Teachers who are allowed to participate in your plan. It's a complicated GASB thing, and they didn't fix it. So that number is clearly both.
That number includes both, and part of it we're responsible for and part of it we're not.
We'll confirm that. I don't know.
I think
it's
the
100%.
Board of Ed employees get those benefits, though, so they've got to be in one of these line items, right?
That's what we need to verify, but the biggest part of that liability, the town will never have to write a check for. The biggest portion of that liability, you will not have to pay for.
Again, apologize. I thought that liability was not in these schedules. I thought it was only in that, you know, kind of the Exhibit A and B schedules, because there was a big reconciling item between there and the budget, right? So I thought that what we're referring to here is ultimately just the pieces the town was responsible for. But if that's wrong, we should clarify.
Yep. No, it is only recorded on A and B because they're accrued liabilities. So it's only up there, but the biggest portion is not a cash flow.
So I'll leave it up to you, Caitlin, to get back to us. All right, thank you. What page you want to start at, Joe?
All right, so I think that's page 24, what we just talked about, Board of Ed, is unfunded plan, the implicit rate subsidy. I kind of tried to explain that, and because it's not funded and insurance goes up, that's why the liability is going to go up. The state teachers retirement board health insurance plan, that's just disclosure only, just like the pension. So it gets recorded in your financials. Whatever the state contributes on behalf of the town is recorded as a revenue and an expenditure. But it's just disclosure only, so the liability that if the state was going to ask the town to pay the liability for teachers, it's $56 million. But the state, when they were looking at pensioners, asking you more to pay the contribution, not the liability. But it would become a shared liability if the town is required to contribute. So like the state MERS plan, those liabilities come back to the town's financials. So if a portion of this was paid by the town, the portion of the liability would come to the town also. All right, so those were highlights of the CAFR. Does anyone have any questions on that before we
Okay,
would?
thank you. Turn it over to the board. And do you have any questions, Mrs. Leclerc, or comments on this? No?
Yep, that'll be the last thing. I just went on the CAFR. If anyone had any questions before I just started talking about the federal and state.
All right. Any questions on the cap? Okay, we'll continue.
Okay, so federal and state, the small one, all good news on federal single audit, unmodified opinion on compliance, which is on pages 3 through 5. On pages 6 and 7 is a schedule of all the federal monies that was spent by the town during the year, which totaled $8 million at the bottom of page 7. We tested 2 programs, child nutrition program, school lunch, and highway planning and construction cluster. We had no findings or question costs for either of those programs in the testing we completed. The state single audit, similar to federal, unmodified opinion on compliance. The schedule of state monies is on page 14 and 15. And the total state monies spent by the town was a little over $14 million. For the state programs, we tested 4 programs, the STEEP program, the pilot program, the colleges and hospitals, body worn recording equipment, LOTSIP, and there was no findings or question costs for any of the testing that we completed for those 4 programs. Required communications, which is just the letter, communication to those charged with governance. So that's just the one letter, separate letter. So it talks about the estimates specifically. So we look at estimates as part of our testing. We look at the assumptions used, your significant estimates that we did test, or the net pension and OPEB liabilities, and the incurred but not reported claims payable liabilities. Disclosures are neutral, consistent. We did ask for management representations, as we do every year, and there were no material uncorrected misstatements. And we did not have any recommendations for 2019. There certainly will be some related to the other project, but nothing separate from that. So future considerations, GASB 90 majority interest relates to bequests and changing the way a town would have to record that if they were the majority interest in a bequest, similar to what nonprofits do now. So GASB kind of followed that rule. It's not something that applies. GASB 87 leases, that is the big one, same basic standard as the private sector. So this one will make every type of lease, including leasing office space, have to be recorded as an asset, right to use, and a liability, present value of the payment stream. So it effectively makes leases all the same, makes them all, the old term, capital leases as assets and liabilities. So that will affect what you see in the financials, both in the back as far as financing, and then additional liabilities up front. So we're recommending that all our clients now start making an inventory of these leases, because there's going to be a lot of calculations that need to be done. What you record will get tied into your capitalization threshold. So we are not really going to be concerned about the water cooler and that type of thing, but the bigger leases we'll need to evaluate as far as the asset and liability. So we will be preparing a schedule that we could send out that'll allow you to kind of start inventorying what you have, so we could start evaluating that. It's not effective to 2021, but it's one of those ones that you really need to start early and know what you're working with before we get there.
Yeah, just if I could, this has the potential to be a lot of work and a very big deal for corporations. I mean, I've seen it. It took a lot of, I know our clients, a year, 2 years to get this. It's complex. I don't know how many leases we have. Most organizations never inventoried them, and then you have to kind of evaluate each one, and then there's different criteria for how you can do the recognition. So it's definitely a project that we should understand what needs to be done and what resources it's going to take to do this, because this is not something you guys are going to do in your spare time, is my guess.
Okay.
Correct. Yep.
Do you have any thoughts on that?
Yes, we're working on a worksheet that will help, like here's the type of data that we're going to need to evaluate that. So that's something we'll get out in the spring, so that you can start that inventory again in your spare time. But it is going to be a project to understand, but it could be tied to accounts payable, because you're going to be making lease payments. There's a way to identify some of that. Again, the thing that people the thing that's really different about it is like this office space over here, the Board of Ed leases, that's gonna have to be an asset and a liability, and right now it's not either of those. So, you know, looking at the terms and figuring out those calculations. So that's a big one, that most leasing parking lots, again, and there are some lessor disclosures, those are a lot simpler. But just the kind of inventory on where you are on both sides is something that, again, if you can tie it to AP or if you can budget your lease payments all in one account, look at the budget process, there's different ways to kind of get that data in one place. But over the next year, and again, we'll give you that worksheet to start with.
Okay. Thank
Right.
you.
Board of Ed, is this a lease that we have on this building? I thought it was I thought we owned like a condominium.
I don't know.
We bought a condominium and we pay common charges.
All right, well, we'll have to look at that, then it would already be capitalized.
Because we had to extend that at some point in time, so. Because if not, I don't know what happened with the 3.2 million or whatever it was that we purchased it for.
All right.
It's an interesting situation for this building.
Right, so I'll have to clarify that, but leasing office space, I guess, is the most extreme example, because people think of copiers and cars and not office space or parking lots or that type of thing. Is this applying to those things?
Does it also apply, I mean, does this rule apply to land that the town leases out as well? Or just leases where the town's a party as a lessee?
There are lessor disclosures, they're just a lot simpler. So there'll be two sets of disclosures. Yeah.
And I don't know how many leases we have. The big part is inventorying everything, so I don't know what that looks like for us, but, you know, usually there's more than we think about, because that stuff's just running through your operating expenses and we're not tracking it like an asset.
We started talking about this maybe 6 months ago or so, so we started thinking about it at least. I mean, we have a bunch of cell tower leases that people pay us on the other side. Parking lots, golf carts.
Right. All right.
Have you guys taken, have none of your clients, none of your public sector clients have any of them implemented this yet? None yet? Okay.
No, I've been talking about it for 2 years as it's coming, but nobody wants to be an early implementer on this one. So you can volunteer, we'll do it for this year.
Yeah, it just gets crazy. Like, if you have a lease and there's escalations in it, there's all kinds of stuff you have to figure out, so it's a little hairy, but.
All right, and then GASB 89, interest costs related to construction projects. They used to say you can capitalize interest in certain construction projects. Now they're saying you can't, so it just kind of really is reversing a prior standard, which I don't think you were applying anyway, because it really more relates to construction and enterprise fund accounting and conduit debt. Again, that not likely to apply, that you would issue debt that you're not responsible for. That's what CHIFA and CHEFA, a lot of loans to hospitals and nonprofits for daycares, so they issue all those bonds, but they're not responsible to pay them. So this is just GASB trying to level set to make sure all the disclosures are same and consistent across the country. So not likely to apply. But so 87 is really the least standard to pay attention to.
Okay, thank you. That wraps it up
That's, yes.
for this. Okay.
Unless you have any questions, yes.
Yes, any questions? Mr. Walsh?
Joe, I don't mean to beat a dead horse. There's a lot of discussion regarding fund balance. You know, you have on page 7, an Exhibit C of the general fund, where you talk about our fund balance, our unassigned fund balance, and you said the rating agency guidelines are 10 to 15%. We're obviously within that range, but you also have been made aware, and I know you worked with our fund balance committee in the past in regards to forming our policy, which says it should be between 8 11%. We're now over 11%. And our fund balance committee is going to be getting together again shortly. And it seems to me that nothing has really changed in some of the numbers that, it's still the same 10 to 15% for AAAs that, you've talked about to our committee before. You haven't heard anything else that it should go down, correct?
I haven't. At that point, I reached out to the rating agencies, and now that this is the information from their chart that said this is what they consider strong. Again, but there are other factors, but that was their rating.
Yeah, it seems high time that we should probably raise our floor, if not our ceiling, but at least the floor, to not go down to 8% anymore. It seems like, with all the progress we've made and that you've detailed in your presentation tonight, and it's detailed in the CAFR, it seems reasonable that the floor should probably become the 10%, because we are above it. You have any thoughts in regards to that?
Well, again, separate from the rating agencies, it's just, in my opinion, I'm on my board of finance in a much smaller town, but the unreliable aspect of what the state does and some of those others, and again, some of the weather-related stuff. New Fairfield had, they did spend quite a bit out of fund balance. Luckily, FEMA stepped up, but you don't always know that FEMA's going to fill that gap.
Yeah.
So just with those type of things, it just seems having a little bit more of a cushion, again, my personal opinion, makes sense. How that affects your rating, again,
Yes.
there are so many other factors, but.
Yes. Okay. Thank you very much for your opinion. Thanks.
Sure.
Thank you, Mr. Walsh. Any other questions on the CAFR? Okay, then before we move on, I'm going to turn it over to you, Mrs. Leclerc, and get an update on the DPW audit and any information from your audit committee that has to do with Joe that you'd like to share.
So, just prior to this meeting, the audit subcommittee had a meeting and discussed the special audit on the public works piece. And in our engagement letter, there were, I guess it's 4 or 5 pieces that Joe was supposed to accomplish during this audit. And he has been working towards that goal. He would like to finish up part of it next week. He's close to, on the first piece with the interviews, he's down to 3 interviews remaining. On the second piece, pulling invoices, I think he just has to really summarize them. I think he's almost done. But the third piece, the bid testing, is still a chunk that has to be finished. And he has spent more of the budget than, it's taken longer than he's anticipated. So we had originally allocated $20,000 towards this project, and he has already spent $25,000 worth of time. And to complete it and to get us the report, hopefully by the end of the month, or close to it, he'd like to go back next week and then finish up the report. So he estimates he needs another $15,000 to finish that. I think it's in the town's best interest to finish that as soon as possible. And according to our fiscal officer, Caitlin Bassi, she estimates that we can transfer the money from within the fill pile allocation towards the audit. So I guess that's what I think we have a sense of the committee that we would like to fund this so we can get the results as soon as possible, and I would just like the board to support that if possible.
Okay, so what part of the audit is not done? What was the third part Mrs. Leclerc was talking about?
It's the bid and quote testing part of it. The quote testing is going to be a little bit more labor intensive because that's not tracked the same way as the bidding is.
So the bidding and the quotes that come from the DPW?
Just for when I'm looking at the vendors, looking at the transactions and evaluating what should have been bid or asking if it was bid or if there were quotes obtained for that in accordance with the policy.
So the total amount would be 35,000? Because Mrs. Leclerc mentioned that you're 25 in.
So it's 40,000.
So is it 40? What, how much total? What's the total?
20 originally, 15 extra, which he says 5 has been spent,
35 total, okay.
Right.
And where would this come from?
Well, the original 20 hit the 1.8. The 1.8 where all the fill pile expenses have hit. So, I mean,
Are there funds left in that?
Right.
I thought
well,
we
I
got a
mean, it's not
presentation.
totally gone. I mean, we're doing an update now. I don't know if you want to bring Brian up now. I mean, clearly you guys got a update, what if, last month or something.
Well, we're gonna
It's- it's
update
close.
in March, right? In March, our March 11th meeting,
Okay.
okay? It's just, do we have the money, if we were going to agree to this, do we have the money currently in that fund? I think I'm hearing you say yes.
I think I'm saying yes. Mr. Carey could probably definitely say yes.
Mr. Carey, do we have the money?
As of today, you have the money. I'm out to bid on 7 sites, and when those come back, there's 2 major things that we're waiting for to come back. One is the remediation bid that I currently have out right now for 7 sites, and the other thing is the investigation of the landfill. I have Weston and Sampson working on the sampling plan for that. We have a meeting with the DEP on Thursday to go over that with the EPA and DEP. Once they kind of review that, we'll have an approved sampling plan, and there will be a cost associated with going out there to the fill pile, the landfill, to do all the sampling required to meet the requirements of the EPA, DEP approved sampling plan. So we're trying to refine those costs. Our meeting on Thursday will kind of give us just the baseline of what we're going to need to do. But we're looking at about $250,000 just to go in there and do the investigation for the landfill itself initially. So right now we have about $453,000 of money that is not encumbered, meaning that I plan on pulling a bulk of the remediation out of there, and then again the investigation of the landfill. I assume that those costs will exceed that $453,000. All of that doesn't have to be done at once. We're going to kind of try to do it as quickly as possible, but I can come back with those costs and we can decide where we need to pull money from. But for the short term, yes, we have money that could be spent to cover the audit. If not, I could pull it from a fees and professional services account through Public Works in the operating budget.
Okay. So you'll be here March 11th?
Yes.
Okay. All right. All right, Mrs. Leclerc, anything to add, or Mrs. Charlton, anything to add?
So there's only one other thing I can add, and that is that we could request that Joe limit the scope on some of the additional work that he would like to do on the test, and if he doesn't have if he pulls a certain number of bids and he doesn't find anything, he can stop, or if he does find things, he can continue a little bit further. Did I approach that correctly?
Yes. Yeah. So I think what I'm looking at is I'm assuming it's going to be consistent. So we looked at a lot of transactions, and normally we would follow those right to the bid. But if we demonstrate that there's something not being done correctly, I don't know that I need to look at all of them to be able to come back with the recommendation of what should be addressed.
Okay. I just want to go to committee member. Do you have anything to add?
Yeah, just, I think, I didn't fully understand the scope of what was in, so just so everyone understands, this covers, operational transactions. I think you said you selected 300, so that's fairly extensive. in my view. It's a very large sample. I'm not sure that we have to go back to 300 transactions to look at quotes. This does not include capital items that, you know, theoretically went through a bid process. So, I mean, I wish we kind of had the numbers in front of us, but I'm not sure that, you know, that we need to do all of them. So I would be fine with limiting the scope. And I do think also that as, you know, if we decide we wanted to dig in further to, you know, selected transactions, it's a perfect project for internal audit. So I would say, you know, select a sample of what you've done, finish it up, put this to bed, and then we can determine based on the report and what comes out of it, what the next step is.
Okay, so then with that, Joe, how much would you be requesting?
I would need to go back and look at the data, so I'm just giving you specific. So I don't know. So if you just approve it up to, or
Up to.
so I will do it as efficiently as possible, because I know you got other places for the money to go.
Okay.
But I'd have to analyze all those transactions and see. Somebody's working on it today, but I wasn't in the office all day today, so I could have a better idea once I look at the data. But I'm fairly confident I wouldn't need to look at them all to get you the same recommendation.
Okay.
Just one other item. I think the audit team has been spending time sitting and pulling up invoices on a computer, and, you know, where we don't have hard copies. And, you know, again, I know we want to get through this as quickly as possible, but, you know, that's an expensive task for them to do. So, you know, kind of understanding what's left, there may be a way. I don't know if that's something a temp could do or whatever, but, you know, obviously we don't need professionals to be doing that sort of task. You know, if we could provide them with the information, that could, you know, potentially cut down the fee. I know we're only talking about another 10 grand here, but it's just thought for this and for going forward.
All right, thank you. Mr. Walsh?
Yeah, I'd prefer not to nickel and dime this. I mean, I can't think of a more important thing right now, to be quite honest with you, than this audit. And I'd like to say it was full, thorough, and Joe was not handcuffed in any way and did the full, thorough audit we had asked him to do. For the limited number of dollars, comparatively to the number of dollars that are going out, I think we owe it to the public to kind of do a full audit. And to spend, if it's an extra $10,000 or $15,000, I really don't have a problem with that, to get a full audit of this entire thing.
Just one comment I would make is this is not going to give us a full audit, just to be clear. I think the way we should think about this is sort of an initial look, and I think we will want, we're going to get a bunch of recommendations that will probably lead us down different paths. And so I fully agree with you. You know, if this is just an extra $5,000, that's not a big deal. I'm making these comments more from the standpoint that, you know, this is a tough project to manage as a board because we're not in contact, you know. There hasn't really been a liaison in the town, and so some of the stuff, you know, it's hard to get some of these things quickly. So I think do what needs to be done to get, you know, this phase behind us, but looking at 100 quotes versus 300 quotes, I think, you know, you also said you're not going to get a different answer, right? I think the key thing will be, in my opinion, we want to see what comes out of this, because I think we always anticipated there would be a phase 2. And that's going to, you know, we don't know what that's going to look like until we see what recommendations come out of phase 1, because there may be a number of internal control findings, and I think there will be, that will then lead us to want to look at other different types of transactions, right? So that's, just to be clear, I don't think this is like, you know, the end when we get
No,
to
I think it's the beginning problem, right?
Mr. Chair?
Also, you know, we went back to a certain time period, so just to throw that out there.
With 3 years, correct? Right. Let me go to Mr. DeWitt first, and I'll come to.
So I was going to say the exact same thing Mr. Wall said, so but I want to make sure I understand. So there's 300 transactions, and some of them are between different departments, right? DPW to purchasing, DPW to finance, right? Is that correct?
Well, they're all they're all out of the DPW budget, and all 300 wouldn't need a quote, because some of them are expense reimbursements, or some of them are clearer.
But they're over multiple departments speaking to DPW, is I guess my point, right?
Well, purchasing is really the department that I would need to interact with to kind of get through what I'm looking at. Again, biz, that they maintain lists and logs and that type of thing for quotes. Again, that system really isn't in place. So that's
I guess what I'm trying to figure out is if there's 300 transactions and 150 are between DPW and purchasing, and then there's 50 between another department, then I want to do all 350 because I want to be able to say all the problems are in finance. I mean, maybe I'm not making sense, but if
I think they're talking about 300 invoices that were paid out of the DPW budget. That's what he looked
it's
at.
an invoice. Okay, okay. So I get it. So your point is, if you found a problem, 10 problems in the first 100, you're not going to find 10 more in the next 200 more than likely, right?
Or better, if you find no problems in the first 100, you probably don't need to test the second two. You know what
Got
I mean?
it.
That's more,
Okay.
I think that's more.
Okay.
Yeah, if you found 10 problems in the first 200, test the second 200,
Yeah,
test
yeah,
the
yeah.
rest. But
Got it. Okay, thank
All
you.
right. Mr. DeWitt, Mr. Testani?
So so it's clear in my head, we need $10,000 right now, is that what we're talking, 15? So we need to make a motion to, are we transferring
No,
funds?
the 1.8 is already there. It's just a matter of authorizing if you wanted to use these $15,000 in the 1.8.
So we need to make so I'll make a motion then to authorize $15,000, right? Is that what we're doing?
Go ahead
Go
and
ahead.
make the motion. It's fine. It's
It's
more, it
Mary's
probably could be a
motion. I don't
sense of the
wanna-
body, but let's just vote, so we said we did it. All right. Mrs. Leclerc, you go ahead, make the motion.
Okay, so
Ask us to authorize,
So I'd like to make a sense of the body of motion to authorize 15,000 additional funds towards the special audit,
up to
Uh,
15,000.
So we can complete the audit as quickly as possible.
To be spent out of where?
To be
Out of the 1.8 that we
out of the
have.
1.8
Okay, I just don't
in
think we
the-
need to have it on the
Yeah,
record.
on the record.
What re-
Yeah.
I'll second.
Okay. That's on the table. All those in favor? Opposed? All right, when can you finish this up? That's my biggest thing.
Yeah,
Can we have a date? You guys have a date?
by the end of March.
Mrs. Leclerc said end of the month, which I thought was next Friday. It was like Friday. So you meant end of next month.
Oh, I thought we were going to have a report for the next week.
Well, Saturday, okay. I'll give you till Saturday, Joe.
Yeah,
What did you think? Mrs. Jarlton, what did you think?
I thought we were going to, and I'm sorry, this was your conversation. I thought that we were going to have the draft report at the March 11th meeting.
if I don't go out till next week, I can't commit to having a report by March 11th.
All right, so your answer is no to that.
I won't be able, if it could be later in the month, I will have a draft, but March 11th,
What's preventing you from, if you said if you can't go out till next week, what's the?
well, I have other things that are scheduled, so I'm not going to get out there until next week. So I'm not going to be able to complete the work and then do the report in 2 days to be able to get you a draft. And so
Okay, then we're going to be in budget season and all that. All right, let's just, by March 31st?
yeah, I'll get you a draft before then. I just can't. I
That
don't.
should be after budget season.
Huh?
Okay. It'll be nice. Maybe we could look at it when we vote on the mill rate. Yes. No, I'm not doing that. I don't, okay, we're good. March 31st. Anything else? Aaron? All right, we're done. Thank you very much.
All right.
Have a good night.
Thank you, Joe.
Yep. Yep. Welcome. Good night.
Okay, we're on to item number 7, the Board of Ed. To review the Board of Ed Quarter 2 fiscal year 20 financial position. Thank you for waiting. We're sorry. We apologize. Said it's 10 of 10. And thank you for the budget books. Okay.
Well, Dorney did
Dorney-
step up before, so I wasn't gonna ask.
I guess before we start, do you have any idea on the OPEB question that was asked?
I don't know what the OPEB requirements are. I know, my understanding is OPEB is after retirement benefits. Our non-certified people don't have any post-retirement benefits. So I do know that part.
They only have pension.
Right.
Okay, so just, we'll work with, Caitlin, can we have some information on by the 11th or on the 11th?
Yeah, what I'm going to do is inquire to Hooker and Holcomb, because they're the ones who do the actuary report. So they have all the data. They know who they used and why they used it and everything else. So I'm going to email them tomorrow and say, can you give me a little write-up on the Board of Ed OPEB numbers?
All right, so we'll come back to this on March 11th.
Have any benefits, then maybe that liability was that implicit liability for the teachers. It's just odd.
I mean, it could be, but they're the ones who calculate it, so they should be able to.
Yeah, okay. Yeah, we thought it worked the way the pension did, or I did. That was what okay. It's not very clear in the CAFR, so.
All right. Thank you. Where would you like to begin with this sheet? The sheet with
I'm
the
gonna,
number?
yeah, I'll
Okay.
talk to this report, the projected balances.
Awesome. Thank you.
Okay. These are our June 30th projected balances as of 12/31. These are the major categories that we report on, and I'll talk a little bit about changes. This personnel services grew slightly due to staff turnover, also some savings and degree changes, and some other areas, extracurricular. The next category of fixed charges, you might remember I mentioned in my written report in the first quarter that we were looking at health insurance, that we couldn't report anything at the time, but we had concerns about that. Well, those concerns are real. We're short about $400,000 as of the second quarter in health insurance. That's due to major changes in classifications. We're no longer self-insured. We're fully insured with the state program, so we pay single, two-person, and family rates, and we've had a big swing to family coverage. So at this point, it's about $400,000 shortage. Some other areas in other benefits brought that category down to about $320 deficit. The next category of pupil services, special ed's relatively consistent. We did have some savings in special ed transportation. Our new transportation director made some changes in the package in the special ed transportation that saved us about $75,000. The next category of support, we had some additional savings there, just small with postage and supplies and stuff like that. The magnet school savings will continue. We added legal fees. We think that we could see those savings in legal fees. The next category of maintenance, the maintenance department itself is doing a really great job of balancing their budget within their department, including the 141 transfer that you made for the fill pile expenses. The big area of savings in that category is electric. We're starting to see the solar savings kick in, and there's some reduction in usage. Some savings from the phone system, some tech savings with service contracts, and some training that wasn't needed, was completed. So that category has a balance of 510, and then we're holding in our capital category, we're holding balances to balance the budget. I think I hit on all the major highlights. If
Okay,
you
thank you.
have questions.
Mr. DeWitt?
So, real quick on health insurance, just so I understand. I understand what you're $400,000 short. I get it. Is this the same program that we've been touting for the last 3 years, been saving us all this money?
Mm-hmm.
Okay.
It's still saving us money, but
It's
when...
still saving us money, but not against the budgeted amount. Is that correct?
Correct.
Okay. So, if we were in the old health insurance fund, we would have had a larger budget number that would have exceeded this number plus the 400?
That's totally different. That's all based on claims, so that would depend on how claims looked.
I guess I'm
Yeah.
just trying to understand. Like I said, for last couple of years, with health insurance as being the big saving thing here, right? We're still getting a savings from being in that plan,
Correct.
even with this $400,000
Correct.
increase. Okay.
Let me just say
think
that...
what we're saying here is there's a shift. I mean, the
There's-
difference is
It's a trend. It is a trend. Okay.
Yeah. Yeah. Right.
there's a more,
So
Right.
that's pretty. If it's
26? Yeah.
so, you're saying there's a large.
Yeah.
So there's just a large negative trend in this particular year. I mean,
Well, so this year, we had a $700,000 budget cut. So when the board in May had to make those adjustments, we knew, at that time, we had open enrollment for health insurance for this year. So we knew that our rates were too low. We had budgeted 7%, and the state went up 8%. So we took the opportunity of making that adjustment when the board had to reallocate the 700,000 cut. We took the open enrollment head counts, so what we knew at that point in time, and applied the new rates to it, and we added 250,000 to the budget. But even then, which was in April, the counts changed between April and July 1, and then remember, as a school system, our fiscal year is July to June, but with the school year being in September, where there's a lot of new hires and, you know, that kind of thing, we have a lot of changes in September, October, too.
yeah. So totally get it. So, if I may, the board was forced to cut $700,000. They took a challenge, maybe a 1%-ish challenge on the number that they thought it was projected, because they had to cut $700,000 from multiple budget lines. Is that accurate? The $700,000 that cut is why we're talking about. At least I know it's partially trend, but you might not have funded it to the recommended level. Or let me put it this way: you might have funded it to the recommended level if you didn't have a $700,000 decrease. Is that accurate?
I don't think so.
No, we
No?
would have had to live with what we had in the budget. Because
What
we
I'm
wouldn't have made any changes to that line item. Right. We actually increased it 250.
At that time.
Just, right. Well, I just want to, are you okay, Mr. DeWitt?
Yeah.
Because Mr. Walsh raised his hand, I want to go by who wants to be recognized, so go ahead.
Maintenance, operation, and transportation section. The last line is heat and hot water projections are not included in this report since there was insufficient data available at the time of this report. But I presume that you must agree that based on the temperatures that you're going to have a significant positive variance there when that comes out, correct? Because I think everybody I know is talking about it has found that their gas bills are down,
We have.
oil bills are down.
We update it every month, and I don't remember what the number was for heat. But at this point in time, there's a lag time in receiving invoices, and we have 2 different invoices too. We didn't have enough to, I think we had small savings.
Okay. I mean, you have to admit, it's been a
So
warmer,
far, at
it's been
that
a
point in
warmer
time.
winter than anybody anticipated. So I guess, why would there be such a de minimis change? If you're not seeing any difference against your budget?
We
Shouldn't
we
you see
weren't,
it?
we didn't hit the heating season yet.
Oh,
when-
okay.
When
So-
we did
oh,
this.
because you're only in December 31st.
So it was
Okay.
December 31st, we
Gotcha.
probably didn't have.
So we should see that in the next quarter?
Yes.
Okay. Same thing as the next quarter, based on where we are right now. Snow removal costs have been basically non-existent. So you should, hopefully, as long as the way I'm seeing the weather project for the next 2 weeks still seems to be good, you should see a positive variance there as well, if things continue along the route through the end of this month.
I hope so, yeah.
Okay.
All right, thank you, Mr. Walsh. Just jumping back to this health insurance, you write in your summary, as suspected. Is this something you suspected was going to happen?
Yes, in the first quarter report, I mentioned that there may be an issue with health insurance when we were starting to get the changes in head counts. You know, you mentioned something, but we didn't have anything solid to report at the time.
Okay. Is there any other questions on that line item? If not, I'd like to go to the sped expenses. Sure.
Sorry to beat this one like a dead horse, but I'm just thinking of it in terms of the upcoming budget season. So last year, when you budgeted the health insurance number, you used existing head count or budgeted head count? Sort of, because one thing that confused me, I mean, I understand that there can be a change in census data if, you know, a bunch of people have babies, for example. But then you said you had a lot of hiring in September. So was this driven by additional employees that were not just budgeted for, or a change in the census data within your employee population, or both?
A change in when you say census and
Well, that's kind of how they refer, right, okay.
right.
So a change in the profile. So you had somebody with, you know, maybe a single person who got married or a couple who had kids, okay. And when you budgeted last year, you said you put 250,000 of, I'll call it cushion in to cover that, right?
No, when we budgeted, we budget with, this year it might have been October 1 or November 1 head counts. Okay, so last November head counts. When we found out at the end of the year that the health insurance, the percentage that we budgeted was only 7%, but the state increase was 8%, and we had to adjust for that shortage, we also adjusted for the change in head counts between October, November, and what we knew of in April.
So you did not budget any, I'll call it cushion for lack of a better term, but you didn't anticipate changes in a shift to family coverage at that time. So this 400,000 is roughly the sum total of what we've experienced this year as a result of that phenomenon.
Correct.
Right, okay. And has that happened is this just an unusual year? Because I imagine it can go up and down. Is this?
It's an unusual year. We've been on this plan with, you know, premium cost since 16, 17, and this is the first time we've hit it.
So there's and just thinking in terms of the budget, is there any reason to believe that we would have another impact like this that should be, or this is a sort of an unusual item, if you will, or an unusual year? Anything could happen, but this is not typical of what we've seen.
I would say it's unusual.
Unusual,
Yeah.
okay, thank you.
But it could happen again.
It's unusual, but it's not 1 in a million, I guess. It could happen, right? It's not predictable.
It's not a trend that we've seen where every year we have a shortage because of these types of changes. We just got hit this year at an unusually high amount.
Yes.
Okay. And the reason I'm asking, of course, is do you attempt to budget for this sort of thing is what I'm questioning.
All right. Same subject?
Yes.
Mr. Walsh, go ahead.
The 7% that you, oh, go. The 7% you budgeted for last year, where did you get that number from? Who told you that you should budget for that number, or is that a guess you guys take internally?
Aon?
Aon, okay. And then it went to 8, and you were told that number when?
In April?
April, okay. In this book that we just received from you tonight, what's budgeted for the increase for this year by Aon?
For next year,
Yes.
10% is in that book.
10% in this
Yep.
book? And we'll once again find out what that rate is in April?
Well, the state came out with, the state went out to bid for a new carrier, and they're in negotiations with Anthem. They're moving from Oxford to Anthem, and they claim that because of this change and the change in the discounts that they expect the increase to be 6.5 rather than the 10.
Okay.
And the 6.5 includes a 3.5% Fairfield County adjustment. It was 2%. We were adding 8. We're taking 8 plus a 2% Fairfield County adjustment, and now they're saying that it's going to be 3 plus 3.5 for Fairfield County adjustment.
And can you give me the definition of what the Fairfield County adjustment is?
I thought it was the state legislature that passed something that said that they had to realign rates based on geographic location. And they came out with a grid of, depending on what county you lived in, what the adjustment was going to be.
Is
And
that
it's-
based on medical costs in that area, or is
Yeah.
it based on wealth from those areas?
Cost.
Costs. So from what's in this book and what you've been told, there's a variance of savings.
Correct.
Okay.
All right, thanks, Mr. Walsh. Mrs. Leclerc?
Do we offer some type of incentive to people to not sign up for additional coverage if they're already covered by a spouse's health care plan? So, like, they don't sign up for double coverage?
Like a waiver?
Yeah.
Only a few in the administrator's contract that was a few people, it's gone, but a few people are grandfathered in that have had it before.
Okay. So was that something we offered previously and now we've stopped doing that?
It's my understanding that it was in the teacher's contract at one point, but it went away. And it has been in the administrator's contract, and it went away except for people who were employed at the time. So when there's like 2 or 3 maybe left. When they leave, there won't be any.
Would that be a way to accomplish some savings for the town, or?
There was a trend for that a while back, but then it moved to if you're not taking it, you're not taking it. Why would we pay you not to take it?
Yeah, just, are you, Mrs. Leclerc, anything else? All right, Mr. Testani, go ahead.
Thank you, Mr. Chairman. I just want to piggyback off what Mrs. Leclerc is saying.
So most corporations, certainly in Connecticut, offer a plan where if you take their health insurance plan and your spouse has health insurance offered, right?
Mm-hmm.
They could choose not to have health insurance and be covered by, like in my case, I cover my wife, okay? Even though she, in theory, could have health insurance, even though she's a retiree from the town of Greenwich. So the town of Greenwich saves money, right, by not covering her because she has benefits through my corporation. So I think, I don't want to speak for Ms. Leclerc, but I think the question she was asking was, why not offer health insurance to current employees, right, current teachers, let's say, some incentive to be covered potentially through their spouse, right, who had health insurance from appropriation, and theoretically be able to save money for the town in that method. I think that's fair.
Right, and I would say that that was a popular, that was popular years ago, but I think premium cost share has grown so much that, you know, what people are paying out of pocket for the insurance is, you know, kind of the disincentive. You don't have to pay that if you don't take the insurance. You see what I'm saying?
And just to clarify on one point, unless I'm gravely mistaken, this would be something that we need to deal with in labor negotiations.
Right.
So it wouldn't be something we'd be able to implement in a budget procedure.
If I could, yeah, I mean, I think what you're saying is, you know, coverage is not free, so someone's not going to get coverage if their spouse already has it, because then they're going to be, you know, paying a premium. And the question would be for an employee, who's got the better coverage? You know, which spouse has the better coverage? You make that decision, and, you know, you're going to make it on that basis. And so if the town offers better coverage, more comprehensive coverage than the spouse might have, or the spouse's premium is higher, you're going to pick it on that basis, but you're not likely to double up, right?
Right.
So by offering an incentive, we may be, you know, the only way that would work is maybe in a limited instance where the incentive was so good that they'd give up the town's better insurance to take the spouse. I think it's probably not, you know, probably not a lot of savings there is what I'm guessing, right, is kind of why it went out of style.
Mm-hmm.
So.
Plus it's through labor negotiations, so.
Right.
Okay. Any other questions on health insurance? Okay. So let's go down to the next topic, which is special ed costs. So what do we have? We're down $1,161,000 on the budget? Yeah,
Yes.
Thanks for being here.
It's nice to be here.
Yes. Yeah, can you just kind of walk us through that?
Yeah,
I mean, what's happening?
we had spoken the last quarterly review, so our deficit has not increased that much, and it's primarily due, as I explained at the last meeting. We've had a significant increase in students with significant medical needs that we did not project. We're not able to project because we didn't realize it. So we had to hire 3 additional one-to-one nurses. In addition, we've had to staff several of our buses for students who are outplaced with medical support to and from school. And then, as we discussed at the last quarterly update, many of our students in district, we struggle with mental health needs and with behavioral needs, and we have built programs in district that enable us to realize a cost avoidance if we had to outplace students. But by doing that, we've had to contract for additional support of our staff at each of our schools where we have specialized programs, particularly for behavior.
Okay, so have we outplaced, we're outplacing more than we budgeted?
We are doing fairly well in the tuition account. We have had an increase in some outplacements this year, particularly for high school students with significant mental health needs.
Is this, just one last question, is this about the same as the first quarter? The negative?
Yes.
Okay. You feel comfortable in saying you think this is about where it will be by the end of the fiscal year?
I can tell you we are working extremely hard to make that happen. This number is based off of, our excess cost projection for made in December was $3.5 million. We're currently working on our March projections, so hopefully we can gain some additional funds through that. But I can tell you, your special ed staff in the Fairfield Public Schools is working very hard to meet the needs of our students and doing the best they can to deliver service in a cost-effective manner to the town.
Thank you. Mrs. Marmy?
I'm just curious because there were hires in terms of social work staff to help, with some of the mental health issues. Have you found that has, are we just holding steady, or is that having an impact in terms of the, keeping our students in Fairfield versus outplacement?
Yes, and we are prepared when we have our budget presentation to the Board of Finance and the Board of Selectmen to show what that savings is for our in-district programs versus if we didn't have them, what we wouldn't be able to maintain many, many students if we did not have the in-district programs we did. But you're right, we did recently hire additional social workers for our high school program.
Any further questions on this topic? Mr. DeWitt?
So for next year's budget, the budget we're going to talk about in a couple weeks, what numbers are in there? Because I heard you say, October data, November data. How current are those numbers?
We gave our best projections for our tuitions, which includes our outplacement and it includes our unilateral placements. And we put in our best projection for our excess cost reimbursement to offset those costs.
Is that based on current numbers?
It's
or?
based on the way we do that when we present our budget, is we project how many students are graduating, and we decrease that from the current number. We project how many students we think will be able to work with families to return to public school. So then we get to that number. Then we project some students who we will not be able to maintain in district for various reasons, and that's how we come up with our best projection.
But we're $1 million off every year. I mean, let's be real, right?
We're
Yes.
$1 million in deficit this year, primarily not because of our tuitions. It's more from the professional expenses and the contracted services. Like the nursing shortage was almost $400,000 that we had to
But
hire.
isn't it the same thing? If we had less students, we'd need less nurses, would we not? It's a proportion, isn't it? Or are there more
Special
higher
ed
needs?
it's a volatile business. We can have students move into district that you don't know that has significant needs. That costs hundreds of thousands of dollars. So we do our best to make our projections as accurate as possible.
All right, thank you. Any further questions? Okay, any further questions for the Board of Ed? Very good. Thank you very much. Thank you. Thank you for being here. Okay, we are on item number 8, to review the town second quarter fiscal year 20 financial position. Mrs. Bassi, which document should we look at? This one?
Yeah, the summary,
The summary?
the projected net estimated operational variance.
Got it. Start with revenue?
Start with revenue. Starting with current prior year levy and interest, it took a swing from Q1 to Q2. The way that Q2 that I'm looking at it, it's a favorable 500 on current, but due to the tax sale that was budgeted this year, they collected $1 million early that they didn't know that they were going to do from basically 6 major properties that had a lot of prior taxes. So I believe the thinking was, okay, if we're already $1 million into the 2, let's not do the tax sale, and hopefully we're going to be able to be favorable. We haven't seen a lot more since those original 6 were collected early in Q1. So they budgeted $2 million for the tax sale. We're still thinking about it, but because of the $1 million that already came in, we're thinking of holding off, considering that we're still at a favorable 990 even without it.
Okay, Mr. DeWitt.
So that's literally the $2 million swing in levy?
That's a $2 million swing. It was a tax sale budgeted. They thought they'd be able to recoup it and more, but we haven't seen the prior year taxes come in as aggressively as we did in Q1. So new administration, new thinking, let's hold off on the tax sale if we can, and given we still think there's going to be a surplus, that's where we are right now,
Without a, okay.
without
got
the
it.
tax sale.
So there's a possibility, though, that if we did a tax sale, we could still bring in more money, correct?
Well, they had 2 million budgeted, and they've isolated properties that they could have gone after,
Okay.
and some of which did come in just through happenstance.
Yeah.
That was a property selling that had prior year taxes on it, and
Sure.
it came in. 6 of
Okay.
them.
6 of them, okay. It just seems as though we could probably use as much income as possible with what's going on with the expenses going out the door on the fill pile. So I don't know if I'd
We
really-
could, but then you're giving up your 18% a year too. So there's pros and cons to
Yeah.
this.
I prefer not to ever do
So-
a tax sale. I mean, I've stated this many times before. I think 18% is the best investment we get. Although now we're making 21% on the other fund, so maybe that's not the best investment. So, but at least the 18%, 18% is 18% is at least, you know, it's not like equities. It's not going up and down. That's a fixed amount. So.
Caitlin, when would you have to make that decision by?
Yesterday. It just takes a long time. I think I talked to the tax collector on, okay, if we decided to go ahead, I'm not even sure that I could get it in for June 30. What they can do is send out letters and not actually go through with it, because that could at some point generate some favorability as well.
Right. Okay, so basically,
We're not doing a tax sale.
we're not doing a tax sale.
Probably not the actual sale. We have time and we've drafted up letters. We're holding off for now.
All right. Investment income?
Investment income, a little bit more possible. We have some assumptions here that the rates are going to stay stable. The mark-to-market decline hasn't happened, so that's our assumption going forward is a favorable 250. Building revenue, as we all know, is going up. I believe the budget for 21 is proposed to increase as well. Again, mostly, and I listed some of the buildings, a lot of Sacred Heart, a lot of Fairfield U, a lot of medical group buildings. There's some very large single-family dwelling, which is on the smaller side, but just a lot of building in town, as evidenced by a bunch of apartment buildings all over the place, as you could see them being built. State aid, basically, slight decline because some actuals came in. No big, deal from the 94 to the 103. And you do have a handout that lists which lines those are. And the other, again, the majority is the fire marshal fees that we're projecting about a 400. That stayed constant from Q1 to Q2. And then there's some smaller stuff. We got a KERMA rebate for 55. A little bit of the housing authority money came in a little bit over budget, 24,000. There's some park and rec stuff that they're doing to try to increase the rental facility stuff down at the pavilions, and they're estimating to be 100 over budget between Jackie and Penfield. So those are subtotaling 550 to the favorable. So those are more than offsetting the negative 460 on the top line. In terms of expenses,
Just a question on the revenue. I'm just, so, trying to correlate to the backup, and I'm not sure to what extent you use this analysis. So I'm looking at the revenue variance report, which takes the budget, half the budget through December, and then it compares that to the actual. How do the two correlate, if at all? So building revenue, for example, we've got a favorable of 300. And then if I go to this variance report, it looks like it's a lot more than that, right? It shows Sacred Heart at 390. It shows a bunch of other amounts that come
well, that
up to-
comment is for building electrical, plumbing, mechanical, and fire protection. So I basically went to the building department and said, hey, what are your big revenue generators this year? They gave me a listing of these buildings, which were major ones. So that doesn't necessarily correspond to the 390, the 57. So then I asked them, okay, well, how much more do you think is going to come in? Because we're trying to project this number through June. And of course, it's hard to project. Some are in zoning. You don't know when they're going to come in because this is really a cash basis. And so that was a number that we felt comfortable with. And then what I always do is if there's a favorability, I always kind of walk over to Linda's office and say, hey, for next budget cycle, what are you doing so that it all makes sense? So I'm saying, oh, it looks like we're going to be 300 over. Are you increasing your budget for 21? And she says yes.
Okay, and I'm sorry, I don't know if I have all the backup, because I did not print this myself, and I picked up my packet, so, did you say there was a list of buildings?
No, there's just in the comments section.
Got it,
I
okay.
kind of took them off.
Okay, so we have this variance report, but, so you look at this, but this is not what you're using to come up with these
Yes, it is.
projections. It is,
Well,
but
those
it's
aren't,
adjusted.
yeah, so I'm using, clearly the actuals are the actuals, right? The budget, a lot of that's just a calculation. That's just telling you where you are as of December. So then what we're doing is we're trying to project out to June. So then I reach out to the department heads. So we know fire marshal fees are already over $359, right? So that's an actual, but that's as of December. So that's actually looking at December of $439, comparing that to the 80, but then you still have 80 more to go. So it's let me talk to the fire department. What do you think you're seeing? Are there a lot of projects in line that you're going to be inspecting? So it's a work between me and them to kind of come up with the projection. Expense side, I'm really going to rename the vacancy number to really salary savings, because they're not vacancies per se in a lot of instances. A lot of it is there's police that retire, then you get a new guy in at a lower rate. So there's not a vacancy per se in a lot of this stuff. And then you have
But there's a difference in salary?
there's a difference in salary between what was budgeted and the new person coming in. There
Yeah.
could be a couple days or even a few months that are open, but it's not necessarily vacant now. So it's creating these salary savings per se, as opposed to a true vacancy that we think of an empty. There's a few vacancies. There's a couple in DPW. No, there's only, because then, I have 2 laborers that I definitely know of that have gotten posted recently. But then you have,
I think there was 12 altogether at
I don't think they're vacant,
but it's okay. I mean,
from a
whatever-
vacancy report.
Yeah, when we asked for specific vacancies, for
Okay.
specific jobs, I think there was like 12 on
Well,
there.
actually, do you know this answer?
Not just for DPW.
Oh, you're talking townwide.
Townwide.
Oh, yeah, so there's a couple in DPW. There's a building inspector. I had an AP clerk who was open I just filled it Monday, for 4 months of savings there. So a lot of this is just adding up these savings. But there
So
are
maybe-
a couple vacancies, or not a couple, I
So
should
should
say.
we split it, salaries and vacancies?
I was just going to actually rename it salary savings.
Okay.
Because there's not a huge number of true vacancies. And again, you could, well, at the moment, I mean, things change too. Like my AP clerk was on here as a vacancy if I ran a vacancy report, but yet she just started Monday. So, and again, you wouldn't see, oh, she has a salary of 50, but it was only vacant for 4 months. So you kind of have to back out the other guy who left, look at her salary to see if it's the same, and then that 4 months is the savings. So would you consider that a true vacancy? I mean,
No, so we're.
they
we're in
get
agreement.
it's just confusing.
Salary savings is much more.
Yeah, that's what I was thinking. And even the fire department gets even, because you have people at the academy and you're backfilling their salary, you're paying their salary, but then you're paying overtime at a time and a half or whatever it is to cover that one. So, is that a vacancy? I don't know. So
Yeah, I'm not, sorry, can I?
Yeah, I
jump
just
in?
want to say something to the board, just so we keep it level here. Just let me know you want to talk, and then I'll call on you, okay? So, go ahead.
What I might suggest, and I don't want to be a pain in the neck, but it feels like you're going through the exercise anyway, and maybe it's just not down on paper. I think it would be helpful to maybe break that number out. As I think about it, there's probably true vacancies, there were partial vacancies, there are changes in salaries as a result of retirements. There's also, we heard about this issue with the trash compactor that caused an inordinate amount of overtime, so.
Well, the deception there is that was paid to an outside vendor. That is not a labor vacancy overtime issue.
Okay, so yeah, okay. So I guess it just, it seems like there's probably a lot of things in that number that go in different directions, so it's just hard
Well,
to.
there's a lot of moving parts, and you also have to anticipate when the new person's coming in and the start date of the new person and
Right.
the salary of the new person.
Right.
So
And you're doing all that anyway.
Well,
But
I was
it
working
just-
with the old HR director who
Right.
we thought we had something, but it's every day it could change.
Right.
Really.
Yeah, I just, from my perspective, and again, not to be a pain in the neck, but it sounds like you're going through an exercise of looking at a number of different things to come up to the 440. And it's just helpful to maybe see the pieces. And the reason is, from a budget perspective, that's where it's helpful to know it, to say, okay, we had more, we had vacancies of this amount, that's not going to reoccur. We had overtime costs, if there were, that maybe won't reoccur. The 440 is probably, the exercise you've gone through is probably some puts and takes that net out to a number. And it's just hard to tell what that is. So that would be my, I guess, suggestion / request, because again, I think it would be helpful to understand the components for this analysis, and then to tie that into how we think about it for the budget.
I mean, really, my starting point is, just so you know, so we encumber all of our salaries. July 1, every active employee, our salaries are encumbered for the year. And as those salaries get paid, they move from an encumbrance line to a paid line. And in a perfect world, your budget equals your encumbrance on July 1 with nothing available. But then all these kind of things start happening. So what I do is I start with looking at my full-time salary line to say, what is the system telling me what is available as of, every time payroll runs, it's different, right? So every week, I have a new available number. And then I take out of that things that I know that are gonna, hey, I'm gonna hire someone March 1st. So I work with HR to say, okay, what's their salary gonna be? When are they gonna start? And then I take that out of the available because there's no one in there at that point. We don't encumber until I have an active person in there. So then you have things like people are getting, like Joe Michelangelo's salary was in there and Scott's were in there, but, and so we have a new superintendent down there, but then you have some of the director saving, so it's really a moving target. There's a lot of things.
And that's why I just think maybe just to help us understand, maybe some of the detail behind the process that you go through would be helpful to understand what goes into that 440.
So here's a
That's all.
suggestion, right, because I get it. There was, and Caitlin was actually a participant in it, a reporting committee and how we wanted the quarterly reports to come to the board. And that's really where this variance report came from. And so, and Mr. Walsh was on that committee too, and I was on the committee. I don't remember the third person. Probably someone that's not here anymore. Do you remember?
Mr. Stone?
Was it Mr. Stone? Okay, so what we'll do is, Mr. Walsh and I will get together, we'll just take a look at these, it's been a couple years, at these reports again. We'll take your advice and put it and come together and come up with something that kind of defines what we're looking at here, because I understand what you're saying. But I understand,
Art than science,
yeah.
actually.
Let's just take a look at what you go through, Caitlin, to come up with this number and see if, okay? Okay, so we're at 681 and then other negative 241?
The other is primarily, there's a negative 400 variance due to a new Enviro contract and the compactor issue that was brought up, which is then offset by some, as discussed earlier, some warm weather savings with gas and electric and snow overtime accounts.
So question for you then. First, where did that overtime come from? What line item did that come from? Where were we paying that out of?
54010 in solid waste and recycling.
Okay. How much money do we have left? I mean, it's probably almost all of it, right? But what did we budget for snow plowing, and what do we have left? We had that one storm.
There's a couple different line items, and that's why Mr. Carey's here, but one is there's overtime, right? I believe that's the 280.
Yes.
So there's clearly a bunch available. We're projecting like 130 savings there, but we don't know what's going to happen the next few weeks, right? So that could be conservative. But then there's the salt issue, which is a little bit more complicated.
Where will we find this in this report? It's in different
Yes.
spots?
Yeah, the compactors are in solid waste and recycling. You're talking about DPW now with the snow
DPW,
overtime.
where would that be?
It's on the second page. Yeah, 5030, it's on the.
So you'll see the snow, the 51060, there's a 130 favorable estimation there. So there's a 280 budget, we've spent 56. But the compactors and other stuff is the page after it, the solid waste and recycling.
I'm sorry, Carolyn, where is that? On page 5?
Yeah.
Okay, I got it. I got it. Okay. Okay, so that overtime is on Public Works operation, snow removal right there. Okay. Could be favorable, 130,000. Got it. Okay.
New contract is still predicted to bring in $400,000 of extra revenue. The new Enviro contract.
You're talking about expenses?
Yeah, that's $400,000.
Unfavorable.
Of
Between the
unfavorable.
compactor and the Enviro contract, it's unfavorable 400.
Both of those are unfavorable. Okay. And the new contract from Enviro was not as favorable? Or is it more expenses?
No, it's more expensive that we didn't know about until the end of November, but Brian could talk to that.
Can you talk about it, Brian?
Yeah, so basically, the contract to actually just, it's for site operations, and Mike Zambrewski's here too as well, if you need to have him discuss it, but the contractor, Enviro, went from, I think it was $35,000 a month to $53,000 a month in the bid last year to just manage the site itself. So that number was not carried into the operating budget for this fiscal year. So that was a deficit. There was only one response to the contract RFP, and they've basically managed the site for the past 20 years. So we asked other, vendors, Mike and I called other vendors to see why didn't you bid this, and there was really no interest from other vendors to bid the transfer station contract.
Do we know the income that they make? Do they have to report that to us?
Per contract, yeah. I mean, it's very specific in the contract what's laid out, and yes, they're supposed to be reporting their income to us.
Is their income down? Is that why they're raising their
I don't know exactly
costs?
what the whole reason for the acceleration of their costs. Mike could probably talk to that
Mike, do you have
better.
any idea what it's all about? Because it seems like the same number of people go down there. I mean, I don't know.
It was a new owner of Enviro,
They changed the sign, I noticed. Right?
and they're buying new equipment, so that's why the price went up.
Okay.
And also, the contract was not signed until November 2000.
This November? This November?
This past November.
Why was that?
It was out to bid.
Oh, it was
We
just-
had
okay.
we had a bunch of towns go out to bid the contracts for trash removal, and it was Trumbull, Easton Monroe, Westport, Milford, and Fairfield. They went out, they had a committee that went out to try to get other companies to bid, thinking that we would get a better price. And the bids came in, and the committees that were out with getting the bids finally got our bid, and it was signed in November 12th, I think, 2019. So we were already into the new fiscal year.
anything else on that, Jim? Yeah, go ahead.
Yeah, on the snow removal line on Public Works overtime, I see what the number is, but in the comment section, you say that this could be $130,000 favorable for the, is that for the year, the whole season?
That's correct.
Okay.
So we've had a couple nuisance storms
Yeah.
where we've gone out sanding and responded, so you do see some overtime there, but between the materials costs, one of the things that's hard to figure in there is actually fuel usage. So you should see a positive variance in that. We were talking about natural gas, electricity, all of those things are trending in a favorable variance based on the warm winter. So I do anticipate that there will be, significant savings in those portions of the budget.
If there was no major snowstorm or no snowstorms for the rest of the year, do you have any sense, have you guys done any calculations on what the total amount you'd save would be?
So basically, what we were throwing back at you was, for this quarterly report, was best case scenario if we didn't have any further storms. I mean, we're almost into March. Generally, once you get to March, I don't want to get too scientific, but the angle of the sun, it's very hard to have a prolonged storm event. I mean, I'm not saying it can't happen, but looking at the weather trends for the next 2 to 3 weeks, there's nothing out there that would pop up to where we'd have a 24-inch snowstorm that would eat away at our budget. It's generally about $6,000 an hour when we're in full plowing operations for the town. So general storm, of about 6-8 inches is about a 16 to 18-hour operation. So you can figure that out, how many of those storms you would need to eat through the budget. But it looks good. It's positive. We have money encumbered for materials such as salt. We're contacting the vendor right now, trying to see, what our minimum purchase requirement was. We have 1,500 tons we're supposed to purchase by contract, trying to get out of that. Close purchase orders, things like that. We'll do that soon, so you'll see the money go back into the budget.
But if you have to buy it, then you have it for next year and you just take it out
I
of the
don't like
budget.
buying the salt because it sits in the shed and
It's
pulls
bad.
moisture from the air. It kind of gets
Ruins
hard
it.
like a rock. You got to break it up. So if I could keep it at the vendor.
Okay.
So do you have what's the total number just on snow operations that you've thrown back towards this number? Because it seems to be mixed amongst different accounts. So it's hard to kind of figure out.
It is hard to figure out. So like fuel usage is one that without the storms, I couldn't tell you until we're at the end of the season. Generally the overtime, and I'll be able to come up with a materials number for next meeting if you really want to know that.
All right, thanks, Mr. Walsh. Back to you, Caitlin.
Okay, given those two items, it's a favorable 440, giving a net estimated variance for operations of 990. Couple that with the budgeted surplus to budgeted contribution to surplus of 1.3 gets us to an estimated increase in fund balance of about 2.3 as of now.
So this is kind of like what we discussed not too long ago, these numbers, variances being able to flip around by millions of dollars quarter to quarter.
I mean, we can control the expense side a little bit more than the revenue side.
Yes.
We don't know when and who's going to pay their taxes
Yes,
and building
without a
revenue.
doubt.
I mean, and we don't know what the rates are going to do on investment. So,
No,
I mean, the revenue's really
totally understand that.
hard.
It's just hard on
Expenses,
the revenue.
expenses we can control, because we're cutting the check. But on the flip side, it's hard. And
right.
that's, in my opinion, I don't want to say it's more like I did more unfavorable than favorable. So I wanted to just put it out there now so that we know.
Yeah.
Yeah, I think given where we were with the estimated variance, then the new administration came in and it was, well, do you want to do this? And it's, getting into it. And again, the drafts of the letters are ready, but they said, you know what, let's hold off if we can.
Okay. Any questions? Any questions on the fund balance at this point?
And then we gotta start meeting. Fund balance committee.
Yes, your committee.
Yeah.
Yes, so
Yep.
I would agree that it's time, right, as we get into the budget season here?
Yeah, it was a good backdrop, though, for,
Yes,
to
it was.
see where we are right now. I thought, Ms. Leclerc, yeah, she was always on the committee. She's been on it since we formed it.
All right. Okay, so thank you there, Mr. Walsh. And when you put that committee, so you bring Mr. Santafonte, you get his advice and you get Matt's advice? And
That's what we did last time. I see no reason not to get them back to do it again. I mean, I think we've kind of heard some of their broad stroke opinions on it, but sure. Yeah. Yeah. I mean, but I'm welcome to take input from whoever we think we should hear from.
All right, good, perfect, thank you. Okay, item number 9, to hear, consider, and act. Mr. Walsh?
I don't know if anybody saw, there was a big fund balance article in the Connecticut Post. It was pretty good, so. Yeah, that wise gentleman up there thinks zero is a good thing. And, you know, one day that's going to bite them, one day that's going to bite him in the butt, but whatever.
They're just a disaster away from a real disaster.
It's one way to keep taxes low.
Except
Mr. Chair?
This is the first year they're actually have a tax increase, right?
Mr. Testani?
Just a quick thought. Maybe we ask the first selectwoman to be part of that committee, with Mr. Walsh? Look,
I think we
this is
should.
a-
I think we should hear from her. But I don't. As we're being on the committee, it's our committee.
Okay. I
So,
just
but
didn't know the
I don't.
protocol,
I would
who's-
love to hear from the administration on
Right,
some of their
that's-
thoughts.
Okay.
On it.
All right.
Yeah.
That's a good idea.
Yeah.
Okay, cool.
All right.
Thanks.
Thank you. Mr. Leclerc, were you about to raise your hand?
Well, last time once the subcommittee came to an agreement, we had a policy by all
Yeah, we wrote the policy the last time. I mean, personally, I think the policy itself has been working the way we wanted it to. I guess it's just a matter of whether we are inclined to change numbers that are within the policy itself. So hopefully that part. No, we don't have a debt policy, and some of us have kicked that around. I had been in conversation. We don't have a debt policy, do we?
Are you talking about the 10%?
Is that formally
Yeah.
written up?
Yeah.
Can you send that to us?
Yeah.
Okay, that'd be great. No, that would be a different committee.
You know what we'll do? Once we get through April.
Lori, I nominate you.
We'll take a look at all of our policies, and it's probably time to review them, possibly update them. For example, we have a bonding policy. It's from 2011. It's time to take a look, and we'll do that.
I think there's going to be recommendations from Joseph Tafani to the Water Subcommittee on that, so that's, I think.
That'll be great. So we'll put it all together. We have a purchasing policy, right, emergency purchasing policy that Mr. DeWitt was involved in. That's also from 2011 about. So we'll take, give or take, a year or two. So we'll take a look at all these policies, we'll get them in line, and we'll see which ones we want to update. And Mr. Walsh's committee will work on the fund balance right now. How long ago was that, Jim?
It was about 4 years ago, I believe.
Okay,
It was adopted in 14.
okay. And it is in the CAFR, so.
Yes. It was
Yeah, the
November,
summary is.
November 4.
It's
We
quite a
adopted
long
it.
policy, so there's only a paragraph or so in the CAFR.
Okay. So, should the policy be shorter? Okay.
I think it should be a little longer.
Mr. Walsh thinks it'll be longer. Okay. Item number 9, Mrs. Bossi, do you have any, do you have any communications for us to consider?
No, nothing that I
Okay.
know of.
Just a reminder to the board, our next meeting is March 11th, which is a Wednesday. I don't remember, I think it's at Osborne? I I think it's at Osborne, okay, but we'll get that out to everybody. Okay, seeing none, we'll go to item number 10. Can I have a motion to adjourn? Mr. DeWitt, seconded by Mr. Walsh. All those in favor? Good night.